All right. Welcome everyone to our weekend discussions on stocks, or I call it as an investing dojo, where we basically train ourselves to become better investors. I learn from you, you learn from some of the topics that I bring in, and I think that's the whole agenda for our weekend meeting is a lot of new folks here, and it's the start of our first meeting for this year. So I'm assuming some of you are coming through okay with a new year resolution. This year I want to invest and let me figure out what's happening, you know, around in terms of investing and who are talking about investors. But so you're joining here. So welcome you all. I'll give a brief introduction about myself since a lot of folks are new. I've been spent most of my life in tech industry. During the start of my career, way back in '96, I also worked in a steel mill, and then I moved towards the technology and have been working in technology industry till 2023. And after from 2023 onwards, I've been completely focused only on investing. But I started investing in US market around 2013 ish. I came to US in 2009, so pretty new to this country. Yeah, 16 years, not that big a deal. And uh, and then since 2023, being focused completely on investing. So that's my journey. I'm mostly a long-term holder, and it pains me when I see on CNBC talking at saying, "Yeah, we are a long-term holder. We hold at least 3 to 5 years. Like holding period is 3 to 5 years, and that's like not even a. In my perspective, that's not even a long term. I would like to give my securities at least 10 years to prove themselves, but that's just me. Everyone is different, and I do use overlay of options to protect portfolio, generate cash flow, and basically reduce the cost basis and stay invested in the market for long term, right? Not get scared out of the market. That's about me. So with that, let's begin our today's discussion. Happy New Year to you all. I hope those are trading options. All the options that you are long on, they are in the money, they expire in the money, and all that you are short expire out of money in 2026. And hopefully we'll all find new opportunities, new ways to build wealth in 2026. Can't complain. Last few years have been great. Cannot guarantee that what 2026 will bring. Uh, Market is excited about it, but no one knows what future has for us. And neither I have a crystal ball, and I don't think anyone else has a crystal ball. If someone is claiming they know what's going to happen in 2026, they're not being truthful to themselves. But I welcome you all. Let's start our new year with I mean, we marketed, I think, okay. We had the first day of New Year, but that doesn't mean anything. Hopefully, we'll do all good. And whole idea is to stay investing. As you guys know, market anyway has a positive tailwind. We just don't have to do stupid stuff uh, to to kill ourselves. And compounding will take care of itself. I see Suresh is sharing some discounts, so thank you very much. Yeah, if you want to get access to Wall Street, IBD, and Market Watch, looks like there is some offer going on. All right, so what's on today's agenda? As usual, I'll give some. Uh, I was listening to a podcast, I think from Bloomberg, where they were talking about some of the ETFs to watch in 2026. Again, there are some new names that I found in that podcast, so I do have a list of those. Um, I'll bring up those for discussion. You can go and research deeper into those if you're interested in. So that's one big topic I want to cover. What else? We finished 2025. So I think it was 2 weeks ago, or maybe it's 3 weeks ago, where we reviewed in terms of what metrics we want to track for tracking our portfolio, like options portfolio, etc. So I do have those numbers prepared for my account. Just want to share in terms of the metrics that I track, and any additional stuff if you track, we can have a discussion on that. Eventually, I'm a big sucker for tracking stuff. Came from my job. I spent 10 years in a fintech building, wealth management or personal finance management products. So some of that is carried away from my job, or maybe it's other way around. Maybe I wanted to do it and hence I loved that job. Anyway, so we'll review that, and this is also the first session after end of a month, and I do share my top 15 holdings of my portfolio. So we'll also share that, and some charts, etc. Anything else you have in mind? I see one comment from Suresh. You mentioned you use options to protect your investment. Would be great to hear more about it if there is time. Sure, we can talk about it. Anything else? All right, so let's dive into today's discussion. As always, anything that we discuss here is only for education. So don't go and trade based solely on, hey, Vivek talked about this, or anyone else talked about this on our Saturday discussion, right? So I always want to start our discussion with some thought for our mind. And the topic that I picked up today is around compounding. Right? And this is again, I heard it somewhere this week. I don't know which podcast was it, or was it some YouTube video around that compounding is convex on the upside and concave on the downside. So it took me some time to understand it. Essentially, all that means is if it goes up, it continues to goes up at a higher rate, right? That's the convexity. I think some of those who are, I guess, traders or follow these VIX graphs will understand the convexity concept. And if it's on the downside, it makes less and less impact. If the share continues to fall down, it makes less and less impact on your portfolio. So in essential, if you are staying invested, you can be wrong 50% of the time and still emerge as a huge winner as long as you stay invested. Right? You don't have to, and I think most of the great investors, their success ratio is around 60-40. They only get 60% correct and 40% wrong. And I'm talking about these are some of the great investors, including Warren Buffett. I will talk about it because now he is retired. So, and this is the only, I think, only game, call it a game if you want to, but or only business in which you could be wrong and still emerge as a winner. We can't do it in a job. If we, or 50% of the time, if you suck in a job, you won't even have a job to do, right? But investing is the only one because it's how the compounding works. So there's a, let me ask you a question. So if let's say you have two stocks. I just want to explain it. If you have two stocks in your portfolio, you started with $100 put in each stock, right? And those are the only two stocks you have in your portfolio. And those stocks have returned, let's say 20%. One stock A is up 20% for a year, stock B is down 20% for a year. And that goes on for next 20 years. Right? What's a virtual CAGR, compounded annual growth rate, your portfolio will have? So one stock is increasing by 20% per year, other stock is decreasing by 20% per year. I'll save you from your calculator exercise. You will be close to growing at 16% CAGR per year. You got 50% right. You were wrong 50% in picking up stock or in investing, and still we could grow at 16% per annum. So that's the beauty of staying investing, and that's what attracted me towards it. think we just have to have enough patience and make sure we don't pick all bad stuff, but it's okay if we can pick, it's okay to be wrong in investing. We don't have to try too hard to try to pick each and every winner. Right? I'm a big fan of just using plain ETFs. I mean, if you don't enjoy tracking companies, you don't enjoy the whole process of investing in terms of reviewing balance sheets or P&L statements or cash flow statements or going through earnings, perfectly fine to just buy a few ETFs and stay invested in it, right? And there will be years when markets will go down. Generally, market have a bear market every 3 years. Last 3 years have been not normal. 2023, 2024, 2025. We all had like almost last 23 and 24 we had 20% plus returns. This year we had 16.35. If you add dividends into it, we are 17 some percent return. These are not normal returns. Right? These are, I would say, exceptional returns. But even if we get a bear market, and I think I have a chart of S&P 500 yearly returns, we could still emerge as a winner as long as we don't do stupid mistakes to blow up our portfolio. And this is the start of a year. And every year I go back and try to view that 20, I think that video came out in 2017 or 2018. Someone who trades option, please keep me honest. James Cordier, not hedge fund, basically a money manager who wrote a book on options. His website or his business was called optionsellers.com, and blew up his account. Right? Stupid mistake. Got too big on one position. So stay invested. Don't do stupid mistakes. Doesn't matter how attractive the opportunity may look like. Doesn't matter that hey, this thing has never happened so far. Make sure you don't expose your portfolio or put your portfolio in a position wherein one black swan event can take you out. As long as we take care of that, we don't have to buy great stuff. We just have to avoid doing stupid stuff. We'll all emerge winners. Investing is not that difficult. I think our behavior is one which makes it very, very difficult. So I'm a big fan of, and these learnings, I made my own mistakes. These learnings have come after paying the tuition. Then I realized it's not a lot. You don't need big IQ. You don't need a great IQ to make wealth in the market, but you need a huge dose of EQ. But that's where we most of us we make mistakes. So you can still be wrong and still make money in the market as long as you stay invested, have patience, and be okay with becoming wealthy slowly. There is only one thing that happens in trying to make quick money, which is basically we blow up our account. So stay away from that. Okay, with that thought, let's look at S&P performance. This is a Chris brings up Charlie brings up very good charts. So this has got a S&P and equal weighted S&P, right? S&P is, as you guys know, it's a market cap weighted, and so it means the bigger companies, the higher market cap companies have much bigger impact on S&P, and that's one I would say criticism that I've seen a lot of fund managers um, basically talking about S&P is it's too concentrated. All the gains are driven by a handful of companies. Whereas the equal weighted doesn't really matter what your market cap is, you're gonna have an equal impact on the S&P. So Charlie has plotted the returns of S&P index as it's constructed, which is market cap weighted, versus equal EQ is a equal cap weighted, and the difference between these two. So if we look at 2023, 2024, 2025, we got almost 34% difference in last 3 years. The S&P and equal weighted difference. So this to me, this looks like including dividends, because 2025 without dividends, it is, I think, 16 point some percent. So, and what this table tells us is last time when it happened, and the data since 1971 goes back almost more than 50 years. Last time this happened was in 1997, 1998, 1999, where the difference between the regular index and the equal weighted index, the performance difference was like 34% over 3 years. So, not predicting anything, right? But history may not repeat, but it does rhyme. I think that's the whole message that Charlie wanted to convey through this. But you got to make your own decision. So what happened here? Prior record was 32% in 1997 to 1999, which of course was followed by, and that was 1999 was our dot-com peak, right? Another parallel which is being drawn in financial media is, are we at the same level at dot-com? Is Nvidia the Cisco of 2000, and so on and so forth. But we know what happened afterwards. From 2000 to 2002, S&P was down. The market cap weighted S&P was down almost 49%, whereas the equal weighted had outperformed the market cap weighted for the next 7 years. So look at 2002, 1 up to 2006, equal weighted outperformed. So in other words, if these gains are be driven by the max heavens, right? And if history is any indication, or if history would rhyme, then maybe it could be a time for, the remaining 493 companies. It has happened once, and then we have seen that the market has rotated back into other companies which so far haven't done as great as some of these large cap companies, right? But let's also be aware of the fact that the companies we're talking about right now, which comprise of those major indices, and the companies of 1997, 98, 99 are different. That's why I'm not saying that it's going to repeat, but maybe there will maybe some portions that it might rhyme with it. So, so today the index, I mean, this is, I don't have to explain. This is index concentration. This I've been talked a lot more. When the 3-year cap weight versus equal weight exceeds 30%, forward 3-year, we see the outperformance coming from equal weighted. So if we're looking for an equal weighted ETF, RSP is an equal weighted ETF of S&P 500 companies, whereas SPY is market cap weighted ETF, right? And generally we see once the rotation happens onto the equal weighted, you will see industrials, financials, energies, small and mid caps will do better than some of those large cap companies. That's history shows us. But if you look at 2025, I mean, some of these energy and industrials and financial, they've already done a lot better. Right? They have some of the top performing sectors, not as much as communication and the information technology, but they've done pretty better. Like they surprised a lot of market pundits, because a lot of demand for energy as well as industrials coming from the same tailwind of AI that is defining those large market caps, right? So bottom line is, this is the widest concentration stretch that we have seen in the last 50 years. Last time when we were here, that was way back in 1999, the equal weighted had outperformed for the next 7 years. So maybe we could do, will not, we may be okay with diversifying some of our portfolio into some other sectors, or instead of SPY, maybe looking into RSP. Again, no one knows when things will happen. No one can time the market except a few YouTubers. No great investor has ever been able to time the market. I am terrible at that, so I don't even try to do it. But I love reading through the history of financial markets, because human behavior doesn't change. A lot of stuff will change. We will the ways to invest will change. The tickers that we invest in will change, but the human behavior doesn't change much, and that's why we continuously go through the similar cycles in financial industry. And hence it pays to read about what has happened historically, just to get an idea and not be surprised if we see similar stuff happening in future. So this is a pretty different way to look at mega cap versus another 493 companies in terms of the overperformance. And once the overperformance exceeds like 30%, 32%, what have we seen historically, right? Now, the other thing that we need to be aware of is, whenever you see any data, you can spin the narrative based on what you want to tell to the audience, right? Hey, you only picked up, let's say, in this case, we can say Charlie picked up the three and added 30%. You could look at it in some other way also, right? That there have been stretches when we had a 5 year of, or in this case, 6 years of outperformance. Oh, now we have only 3 years of outperformance. So you can, essentially, you can spin the data whichever way you want to. Right? Just that this is one way of looking at the data. And many of these companies that are mega caps, some of them are still available at reasonable valuations. Many of them are extremely valued. So just be aware that the party doesn't continue forever, and there will be times when the music will stop, and I think we'll do good to our portfolio, make sure that we are diversified and not hugely concentrating in very few names that have performed well for last 2 3 years, like most. And GDP growth as well as the stock market growth, most of that growth over the last 3 years have come from just one theme: AI. If that theme continues, great. If that theme does not, then we as an investor, we do good to look and invest in the sectors or the companies which are not driven only by AI. So that's the message. You do what you feel best for your portfolio. Any other comments? So I saw another one, a link on Bloomberg. Thought I'll share with you. And Bloomberg has done a different way of sharing what some of the Wall Street firms think about what's going to happen in 2026. I think 2 weeks ago, I shared a chart in terms of the price targets. And the price targets are, I think everyone is bullish. Price targets are, I think, from 7,000 SPX target all the way to, I think, 8,200. So I think the minimum is like 3% all the way to up to 16% upside that's what the Wall Street is expecting. What Bloomberg does, and it is also to compile what Wall
Sorry,
Street.
Vivek, could you scroll down a little bit? Right now, we're just seeing, the what to expect and then just the top of the S&P, not the chart.
Yeah,
At least.
I'm deliberate. I'll come to the chart.
Oh, okay. Sorry. I thought
Yeah,
you were
yeah.
talking about it, so I thought you were actually
Oh, no,
mentioning.
no, that's because
Okay.
that is 2025. So I just want to build a base before I show the
Okay,
chart.
no problem.
So, but Bloomberg does categorize this information a different way. So I want to share that link with you. But before we get into 2026, again, no one knows what's going to happen in future. So here's what the targets of Wall Street firms were for 2025 at the start of 2025, which you see on the left side. I think the highest was 7100, and then we had tariff tantrum. All the firms, they reduced their year-end targets. So these were the year-end targets, and in mid of 2021 the year-end targets were all down. Like some of the firms were talking about 5500 because the market was down, right? And then end of 2025, this is where we ended up. So again, take it with a pinch of salt. I think someone has said that these price targets, don't think of that as a GPS. They're not going to tell you exactly where the S&P is going to go. And most of the time, these forecasts are wrong. But treat it as the compass. They may be directionally okay, but be way off in terms of the magnitude or where S&P might end up. So don't go and, I would say, change your portfolio thinking, oh my God, the folks are talking about, you know, 8,000. So let me load up on some long dated, leap calls, for example. I would never do that. I don't think the folks who have given target of 8,000, even they believe that they may be that the S&P will end at 8,000. Is anybody's guess where the market will go? So we got to be prepared with that. But maybe directionally, I'm actually more interested in the data that they use to come up with that target. So this is I'll share this link, and let's open this up. And this is the reason why I like this more than the just the price targets is you can actually look at and analyze the data in different ways. So what Wall Street expects in 2026? So basically all they're looking at is you can analyze that in terms of what the street expectations are under different categories, right? So for example, what do they understand? What's their expectations from a growth perspective, right? And now you can scroll through and see, okay, what does Citi expect? Citibank is expecting around easing growth in developed markets from close to 1.7 to 1.6%. Emerging markets almost 4%. Who else you want to look at? UBS, again, same 1.7% developed markets, 5% on the emerging one. So it looks like most of them are a lot more uh, bullish on the emerging markets, which is a theme that we heard, especially even this year. The non-US market have done better, um, so which is surprising because most of the last whole decade the US market has done better than the emerging markets or non-US market. But this year the markets outside US done much better. Now Apollo Bank of America is thinking US GDP growth of 2.4%, and then they're looking at China adds around 4.7% is what they are looking at. You want to look at and analyze it from inflation perspective. You can see what these Wall Street firms have to talk about from an inflation, right? What does Fidelity thinks? What Capital Research thinks? Now you can let me know which area you want to focus on, and we can probably dig deeper into that. Or
Vivek,
yeah,
on China growth, people just take the governments. They don't come up with their own estimate or their own confirmation of China state figures.
but
I found this out about 30 years ago or 25 years ago that analysts, USA analysts, and banks and they just quote the government, and if there's any changes, they act like they're geniuses.
yeah. So I would not completely blame analysts for it because the growth in China is driven also largely by a lot of government initiatives, right? So each of the governors of the provinces have a targets on what GDP growth that they have to achieve, and some of it is, and we are also seeing a negative effect of that. That some of the growth, just to show that they are achieving the growth given by, let's say, the president. There have been some work that has been non-productive work that a lot of these provincial governments have engaged into to achieve the GDP growth. But
What I'm
it's,
saying, Vivek, is I mean, back 100 years ago, it was inaccurate. 50 years ago, it was inaccurate, and so what they're doing is they're building on stats that are incorrect. Yes, they're getting more accurate, but the thing is, the foundation is wrong. So
yeah, yeah, I don't know that historic data, but uh, when it comes to China, and you said that they take the government numbers, and probably it is because a lot of these investments are driven by government. Anyway, so you want me to look at any specific one, stocks, bonds, AI, tariffs, or a specific institution? We can dig deeper into those. Let's say Bank of America and US. What do they think about it? Right, let's say look at the stocks. So Bank of America expect that we'll have a 14% EPS growth, which is great. I think for 2025, the estimates were around 12%. Now we are assuming that the earnings will grow even at a faster pace in 2026, but only 4 to 5% S&P price appreciation. Right? It is because market is already have run up in anticipation. So they're expecting only 4 to 5% with a year-end target of 7,100, which is not
But
that attractive.
right, but something. So just general thought, looking at that, right, is that then it may make more sense for this year to be more in the equal weighted one, right? Because, like you said, a lot of the run up has been in that top 7 to 10 or so. And, but if you're expecting overall earnings growth of 14, 15 across all of them, you probably will get a higher return, I would think, on
The remaining
the weighted
490.
one, right? Just yeah, just
Yeah. So, and again, we don't know when these are just
नहीं
the
यार ये डिफरेंट है. अच्छा मैंने इवनिंग खोल लिया.
Ashwari, you have a, I'll have to mute you. There was a side talk. And again, these are the different estimates. We don't know how much will it pan out, or maybe we can look at some other financial institution and see what they are thinking about it. But I think at a consensus level, it's between 13 to 15% earnings growth. But of course, the year-end price target or the S&P appreciation is different based on whatever the analysts are thinking in terms of how much is already priced in or not. But one thing which I'm still waiting, and I don't know whether it will pan out in 2026 or 2027. It definitely didn't work out in pan out in 2025, which is the actual benefit of productivity gains coming to, let's say, the real economy companies. So far, most of the gains that we have seen in AI have been limited to the tech companies, right? And also the profits for those from those market cap appreciation have also been limited to the companies that have been providing these AI models, right? Most of the productivity gains have been on the tech side in terms of more efficient coding and all that stuff, but probably also a little bit on the financial services sector, right? In terms of that too, mostly on the investment research side. But we haven't seen those gains yet. Let's say reaching out to the companies, making supply chain more efficient. I haven't seen those showing up in the business results just yet. Maybe it will take a maybe this year, maybe by next year, when we should see the real impact of AI into the business, right? From a productivity gains. But let's also make sure and understand that productivity is not equivalent to profitability, right? Which, if you're not, if you don't think deeper, we could get confused in terms of, oh, if you are more productive, maybe your business become more profitable. It will be more profitable only if you have moat in your business. because the competitors will copy this. They will also have access to the similar technologies, and very soon all the initial profitability that you gain from productivity improvements, they will be dissipated. I think Professor Damodaran has said in very nicely uh, this concept, saying if everyone has it, then no one has it. That means advantage. If everyone has a computers, let's go back to 1960s, 70s when the computers were just getting into businesses. The businesses that computerized their operation, maybe at the start of the cycle, were able to gain efficiencies and also became more profitable. But once the competitors start to catch up, they all became more efficient, they all became more productive, but the profitability eroded because the margin will still start to get compressed because now we have competitive pressures. So in the end, we might become more productive, and I think the companies that are in forefront of using the technologies, those who are leading with it, will also enjoy higher profitability, expanding margins until their competitors catch up. Or if they have a mode in the business which is not a technical mode, because technology mode will be doesn't stay for long because the competitors will be able to catch up. So that'll be interesting to see. I'm hoping, maybe, I don't think maybe 2026, maybe 2027, we should see some of these 493 other, not non-tech, or let's say companies outside of information technology and communication services becoming much better businesses by using AI. And then that should expand their margins and should help in higher performance in terms of stock appreciation until everyone else catches up with them. So that's going to be interesting one. But we'll see. We'll see what happens. Uh, what else? Any other financial institution you want to look at? How about Goldman Sachs? Goldman Sachs from a US. Right now, I'm just on the US side. They have not given a target, but AI capex boom set to extend, but valuations are run ahead. So I think they are also concerned about little valuation. So higher volatility, wider credit spreads, likely with equity upside. Let's look at Apollo, because I think I read somewhere Apollo had become more conservative and were raising cash. Well, let's see what they have to say and how they're moving their money. Uh, let's go to the stock side. The forward-looking view of consensus is that AI will continue to drive the performance. And investing in S&P 500 today means largely investing in AI, means the index no longer offers the diversification it once did. So I'm not surprised that Apollo manages close to $100 billion, that they have started moving some of the portfolio that they manage out of S&P and into other sectors, or maybe raising a little bit more cash, because I mean they do think that S&P doesn't provide the diversification, so everything is tied to AI. And if this tailwind of AI starts to reduce, it's going to impact the portfolio, because if you're holding S&P 500, it's really not that you're holding a diversified portfolio, right? What else we want to look at? AI bubble. No bubble, no problem. As the AI story continues, expect continued foreign investment in US assets. Forward-looking view of consensus is okay, that we already looked at. Uh, while we do believe that AI will continue to grow, if there was a slowdown, we can expect the impact to be felt across the economy. It would have negative consequences not just for data centers, but also for the stocks, consumers, and beyond. We'll be carefully monitoring any signals of weakening AI demand. Okay, so that's why they become a little more conservative. There we go. 30% recession probability. Okay, that says it all. Right. Any other Wall Street firm you want to look at? Or do you want to look at any other country? We can go all on all, or we can just move forward. You can probably look at it at your own convenience at home if you want to dig deeper into these things. But I found it really a good way. Let me look at, oh, they have only Europe and US. How about China?
Can we look at the one that is giving us a low expectation?
I think we can only filter in terms based on institutions or the regions.
But you mentioned that somebody expected 3% negative.
Not negative. I think the overall Wall Street estimates are from 7,100 all the way to whatever 8,200. So if you look 7,100, it's maybe around 3% or something. Pranav says India. Nobody is actually generally talks about India, so probably get clubbed under emerging markets. There is no separate category on India. India still doesn't consider to be a huge market when it comes from a global perspective. But there are emerging markets. Emerging markets, people are very constructive. Heading into, because now they're thinking maybe we might get the rotations that we have been waiting for in terms of, money moving to out to other countries than just US. Because US, if you look at 26% of GDP, of world GDP, and 70% of the investment or the stock market um, equivalent. US market is 70% of the world stock market, right? Our GDP to market cap is way out of whack. This is called the famous Buffett indicator. So I think a lot of firms are thinking that we're gonna get rotated, and maybe US exceptionalism has run too far, and probably there are better opportunities outside of US. So emerging markets now, I mean, this year Europe has done much better, right? Um, JP Morgan, so the top of credit. Let's go to the stock alternatives. I don't even focus on. Where's anyone on the stock side? What do they think on the stock? Bonds, stocks, high to higher. Wow, that's a big endorsement. High to higher. So even if some of the stocks are high, probably we're gonna get higher. Emerging markets, bright spot as we enter 2026. State Street says for emerging markets, we hold a broadly constructive outlook heading into 2026. Let's say what BlackRock has to say. I'm just picking up the names that we are familiar with. We like EM hard currency debt technically given attractive income, limited issuance. On a long term, we favor emerging market equities at the cross current of mega forces like India. So they are bullish on India. Schwab may provide alternative way to participate in growth of AI. China, for example, Fidelity. Accommodative fiscal and monetary policy, decent earning means we are risk on for equity since emerging market equity particularly look attractive, right? So most of Wall Street is now, after a long time, is looking to outside of US. Sorry, yes, the S&P does not provide diversification. What provides diversification? I mean, there are either you could do on a sectoral basis, right? There are sector-based ETFs for each of those 11 sectors, or you could do equal weighted. It means that the big companies, if all the other companies also have the similar weightage as, let's say, some of those big companies of S&P. So those are two ways you can still diversify your portfolio. Any thoughts on how things will be affected? Dollar continues falling. So if dollar continues to fall, then emerging markets will even do better because their debt becomes cheaper and cheaper. It becomes a lot more cheaper to service your debt. And once you convert your uh, earnings back into dollar figures, you get a boost by falling dollar. So the companies that have a businesses outside of US will be able to report better dollar denominated results if dollar weakens. And it's conversely, it will be if dollar strengthens, then if you have investments in a companies that derive a lot of their revenue outside of dollars, and when they report the results, you will see those are depressed or compressed because of just the strength in the dollar. So if dollar weakens, then the non-US market looks more attractive when priced back in the dollar. Am I doing anything to protect against that? I think 30% of my portfolio is on US, so I'm adding a bit more on the non-US side, right? The other thing is, hey, I just want to make sure I don't become too big on the AI, etc. Right? Because even if US as a whole might underperform, but there will still be sectors or the companies that will do, let's say, better than S&P 500. You just want to make sure that your portfolio is diversified. Right? Again, I'm not going to make a drastic decisions of selling portfolio and getting hit by capital gains tax and buy companies that I don't understand or invest in the countries on which I have no idea how they operate. Right? That's the worst thing we will do. Um, Underperformance doesn't mean that the market is gonna wreck your portfolio. It just means, hey, there are better opportunities somewhere else. But at least personally for me, when deciding in terms of where to invest in, there are other things that also come into picture, right? Do I understand the market? Do I understand this sector? Do I understand this company? Are there tax impact for me? Are there currency impact? Because if you're investing outside, you'll have a currency impact on your portfolio or the earnings of the companies that you own. So a lot of things come into picture. All right. Before we move on, anything else you want to look at? Any other firm, or let me just look at China. That's always interesting. And then we'll move forward. So China 4.7%, 5%, 4.8 to 5%. We generally slow, right? So China generally is like more than 5%. And right now, I think 5% is the limit. I've seen China growth numbers earlier 6%, 7%, 4 to 5%. Morgan Stanley they haven't given number. But even if China grows, I mean, China hasn't been growing. They have been having tough time for the last 2, 3 years. Hopefully, if the real estate sector comes back, we should see better growth in China. I think right now, most of them are looking at 4 to 5% growth from
Vivek,
GDP perspective.
China had tough times since 2019, before the pandemic. That's the fact.
Yeah, but we didn't. The rest of the market didn't know. We started to know about it after the housing bubble crashed for the last 2, 3 years.
So Vivek, I'm arguing with all these AIs because I was there, and they're saying that China, they're doubtful that China has been more powerful since 2009 than now. How do you see it?
China has been was more powerful in 2009.
No, well, the last thing I'm arguing with AI is they say in some metrics China is more powerful, but I say they're totally more powerful now than 16 years ago. What's your view?
No, I think so. China does have its strength, but I don't think they are powerful in all the sectors. But yeah, there are some industry where China still is the king. No one can beat their manufacturing prowess. However hard we may try, it is very difficult at least on the US side, given where we stand today, to scale manufacturing. We can't scale it at a way at which China can scale their manufacturing. Right? China is catching up on AI. We are seeing their investments on the semiconductor. They want to be independent. There was a news that they figured out how to do EUV, which so far only ASML has that technology in the world, but China says they have done a prototype of it. I don't fully agree yet because they reverse engineer the DUV machines to probably generate EUV, but the overall ecosystem will take a long time. But given how fast China can move, they could actually have a passable EUV machine maybe in 5-6 years, right? ASML took 16 years to commercialize it. China could do it in, let's say, 10 years, half the time. Right? But there are areas where I think US is still stronger. So I don't think we can put a blanket statement on, okay, now China is stronger in every aspect or US is a lead on everything. I think we still both have our own areas of strength. But if you really want, China is growing fast. I mean, I was amazed by the book Breakneck, and I think the same author has written. I saw on Twitter, Bill Gurley, he published his year-end note, and it's on my weekend reading list. What Dan Wang has to say in his year-end note, because I really liked his book, and I reviewed that book in one of our meetings. Coming back to from an equity performance, UBS says liquidity retail flows. I don't know if I agree because every time we have this liquidity discussion, the Chinese government will come and talk about how they're going to inject liquidity, and then the market will go up for some time. After 2 weeks, it's all fizzle out. And I've seen this story at least 4 or 5 times in the last 2 years. So I will take it with a pinch of salt that hey, injection of liquidity, easing up of liquidity from Chinese government. Um, Call me once bitten, twice shy. Uh, we have had similar announcements by the government in last 2 years. What does Morgan Stanley has to say? China with region losing ground in manufacturing to China. So they're saying European and emerging markets are likely to benefit from same tailwinds that boosting US stocks, but Chinese stocks face headwind from low reflation progress. Yeah, so people are not buying in China. They're still struggling because of the property market is down. China outperforming the emerging markets in 2026 are subdued. That Robeco, I don't know which this firm is, so I'll skip that. What does Citi say? Despite concern of equity market bubble driven by AI, diversification into China's AI value chain financial base metal is recommended. By the way, Baidu had a great Friday, right? They released something on, I guess, on AI. There was some news on Baidu and stock was up 15%. That seems to be an AI play. Which book? The name of the book is Breakneck. I think it says how China engineered its growth in future or something. Breakneck Dan Wang. Yeah, China's quest to engineer the future. It's a good read. Okay. All right, let's move on. Enough of predictions. Again, at the end of the day, we don't know how many predictions will come true or not. But this is what Wall Street has to say. So far, how are we looking at a sector-wise? We're only a couple of days for this year. And see, industrials, energy and materials are like on the top three. And consumer discretionary, I mean, we can skip it. It's only 3 days. Doesn't matter. But over last 10 years, we're still seeing discretionary, largely driven by, I think, companies like Tesla. Communication services, tech have still outperformed. S&P 500 over the last 10 years is like 235%. Even if we are not done, any sector specific, just staying in S&P itself have had a decent returns. So nothing to complain about. And 5 year is 82.6%. And this is where we are lapping the 2020 mania. So understandably, 5 year is not that great. I mean, 82% not bad, but not that great either, right? So I shouldn't say that. Maybe I'm becoming more greedy. 82% for 5 years is decent, but we basically lapped the growth of 2020, and so 10 year is seems to be a lot better than 5 year. Right? Fear and greed index at the end of this week we are in neutral. So again, just this is again kind of a compass, helps me. I want to go out when there is a blood in the market, become a little more aggressive then in terms of adding to portfolio or becoming a little more bullish in managing my portfolio, add more bullish trades to the portfolio. But if it is a greed or extreme greed, I would like to take a step back and just watch what's happening in the market, right? Just from that perspective. We have no idea. I've seen markets stay in a greed and then extreme greed for longer than I would want them to stay. But that's okay. Cycles happen always. And I can be patient to wait for the market to do its thing, right? Human behavior, we always go through this cycle of greed, extreme greed, and then it will blow up, and then will become uh, so despondent, saying, "Yo, there's nothing good can ever happen in the market." That's the time to go out and shop. Pamela, where do you get this index? It's just Google for CNN Fear and Greed Index. I just want to bring every week and show, okay, what's the market is thinking about it, right? And I don't want to go out and shop when everyone else out there is clamoring for and willing to pay higher prices for the same goods. And I love discounts. So rather go and shop when the market is giving me some discounts. Anyway, other big news for this week is Warren Buffett retired from Berkshire Hathaway, as he had indicated earlier that he will retire by the end of 2025. And now we have a new leadership. Greg Abel has been with Berkshire for many, many years. He was in charge of non-insurance side of the business. As you guys know, Berkshire Hathaway has a diversified set of businesses. Insurance is headed by Ajay Jain, and non-insurance businesses are headed by Greg Abel. And so there was always a debate in the market who's gonna take over. Buffett made it clear during the 2024, I mean this year shareholder meeting, that is going to be Greg Abel. So he's going to step into Buffett's shoes. But what an investor he has been, right? He's, at least of my lifetime, he's been the best investor, right? He's been the GOAT. Looking at a Berkshire Hathaway from 1964 onwards, I guess, it has compounded at almost 20% per year, which is almost double of what S&P 500 has done. In an absolute term, you're looking at 6 million% return as compared to 46,000% return on S&P 500. Right? Not easy to do it. You can do it maybe once a while. There are many, many years wherein a lot of fund managers have outperformed Berkshire Hathaway, but over a long period of time, over 60 years, no one has been able to come even close to what Berkshire Hathaway has done. Berkshire shares could decline by 99.2% and would still outperform S&P 500. That's amazing stuff. However, it's not just the return, but it's the way Warren did it that matters the most, with integrity and morality and with humility and humor. Right? Don't go and do stupid stuff. Don't go and over leverage your portfolio. Don't take too much of a risk. Always think about the end shareholders. I mean, he has done his own mistake of in terms of, I think it bought Dexter shoes. Buying the company wasn't a mistake. I mean, the company has gone to zero. That wasn't a big mistake. The big mistake was he paid using Berkshire Hathaway shares. And then I think he came and talked about that's the stupidest thing that he ever did. And even after like 50 years, that still pained him because the Berkshire, the opportunity cost of buying that business kept on compounding year after year as Berkshire kept on compounding. Right. So I think I had some numbers somewhere. Or maybe I shared it in my thread of tweet where okay, learning from the annual shareholder letters of Berkshire Hathaway. So yeah, what's an amazing investor. I'm fortunate to be alive when we could see and learn from Warren Buffett. So my, I think, best moment this year was I actually went and attended in person. I talked about it in after I came back from attending the annual shareholder meeting. I think that's it was on my bucket list and turned out to be a momentous occasion because Warren was in this annual shareholder meeting, but he's not gonna be uh, in let's say 2026 annual shareholder meeting. So I was just fortunate enough. I think I was lucky enough that I attended only one Berkshire Hathaway meeting, and that turned out to be the last one. And of course, the lot of other stuff was I was able to meet some of the great authors and other investors and have a picture with William Green and a few others. One.
Vivek, did Buffett show any signs of Sleepy Joe
No.
or a Trump gas?
No way. He was so sharp in the meeting and he was still rattling out numbers and the figures from 1960. This is what Fed did in terms of interest rates. At least that was the case in the annual shareholder meeting. I don't know in last 8 months things could have changed because at this, but he was sharp as ever. And this is amazing. I mean, he's got such a sharp memory. He could just read a lot the numbers in terms of this is what Berkshire did in 1970s. He was talking about insurance and oh, this is what happened. I mean, I don't know how he can remember everything. He was very sharp. So, a few quotes to honor his legacy. The stock market is wonderfully efficient mechanism of transferring wealth from impatient to patient. We get the only way to make money in the market is to make it slowly. I would say, if you don't find a way to make money while you sleep, you will work until you die. I think this is what goaded me to figure out I need to start investing. Job is just not enough, right? Otherwise, I'll have to keep working until I die. The best investment you can make is investment yourself. The more you learn, the more you will earn. Be fearful when markets get greedy and be greedy when markets are fearful. That is why I keep an eye on fear and greed index. You don't have to be smarter than the rest. You just have to be more disciplined. Just don't do stupid mistakes. Right? A lot of smart people with great IQ have blown up. Like LTCM is a prime example. We talked about it in the session where we reviewed the biggest mistake of greatest investors. Highest IQ per square feet anywhere in the world. And that firm lasted what only 4 years and had to be rescued by US government. They got two Nobel laureates who were building financial models for them. They were not disciplined in terms of risk management. Right? Do not save what is left after spending, but spend what is left after saving. Age-old wisdom is spend less than you earn and invest. Easier said than done. Investing is simple, but very difficult to implement. Concept is so simple. Only buy something that will perfectly happy to hold if market shut down for 10 years. Right? And the other, I think there is another quote related to this is consider that you're holding a punch card and you're only allowed to have 20 punches. I don't think any, I mean, I can't even do that. 20, holding only 20 over the lifetime investments, not going to work for me. Right? But we try to be more disciplined. Don't run after everything that is hot. I made those mistakes. paid the bills, saw my portfolio losing one third of my portfolio, and then what the heck I did. I didn't know what I was buying. I bought what some of the other investors were saying that is a great company and didn't do my own homework, right? So buy something that you feel comfortable holding. And if you can't find anything on which you have built your conviction by looking at business, stay invested in ETF. There is no shame in it. I mean, I don't know why we're glamorizing buying individual companies and trying to make, 5x in a year. Most of the investors will lose money trying to do that. And I would say there is no harm, no shame. If you don't enjoy the process, just stick to ETFs. Stay diversified ETFs. Enjoy the rest of your life. I mean, the life is a lot more to offer and too short to spend only thinking about money. And unless you enjoy the process, better do other things that you enjoy, right? At the end of the day, we're here to make our lives better. A big bank balance is not going to do us any good if we have been, you know, like lived a pathetic life in achieving it. I invest in individual companies because I realize I love going through the companies and understanding the businesses and stuff like that. Even then, my biggest holding is S&P 500. So that's I thought I have a lot more quotes, but then we'll need one full day just to go through what Warren Buffett's quotes are. But you can Google it, you can find a lot more. The idea is, hey, pick a few and stick to it, right? It's easy to get the quotes. It's very, very difficult to follow it. All right, any other questions? I'll sip some water and then we'll move to next topic of ETFs to watch in 2026. Jay Singh, it takes 20 years to build reputation, 5 minutes to ruin it. Yep. And he said that after Salman Smith, Barney, they blew up and he had to come and fix it. Anything else? Nope. All right, so let's look at some of the ETFs to keep an eye in 2026. And not necessarily that, that we are expecting them to grow, but I think it was on a Bloomberg podcast. So I thought, okay, let me get this information out to you. And I heard a lot of new tickers. So this is the fun part, right? So hey, I'm also learning along with you guys. So one of the tickers is BINC, which is Flexible Income ETF. So this is an active bond ETF managed by Rick Reader. Rick Reader, you probably know, he has been a very famous Wall Street personality. I would say personality. BlackRock's. I think he's a vice chairman of BlackRock, if not wrong. After one layer after Larry Fink, and he's also one of he was on the short list for Fed governor. He was one of the candidates that was shortlisted by Trump administration to be the next Fed governor. So he knows his chops, and he manages the active bond ETF, and it has outperformed the aggregate bond index, but more importantly with lower volatility. So if you like lower volatility in your portfolio and you want to have a income, maybe rather than getting ag, which is like a lot of fund managers have it, this is another ticker, BINC. Fee is 40 basis points, right? The other one, which is box, and this is basically uses box spreads. You guys know I did box spreads couple of times in 2025. Just to My idea was to basically get a loan from Schwab, but not pay 12%. But if you take the other side of the house, in terms of if you are giving loan to someone, you can get a rates which are equivalent to treasury rates, right? Because I raised cash from Schwab very near to treasury rates, which is 1/3 of the margin rates which Schwab otherwise would have charged me. But on the other, if you go on the other side, you can sell a box spread and get paid a treasury rate, which a lot of investors do. But what this BOXS, what it tries to do is basically a play on not to pay taxes. So that will enhance your after tax returns. Right? So, but if you are just implemented box spread, you get paid treasury rates, but then you have to pay taxes on it. The way the box implement their strategy is they are not distributing the gains to you right away. So it comes as a capital gain tax treatment rather than your ordinary interest when you receive from a box at, rather than ordinary income tax, it becomes a capital gains. Or if you just don't know how to figure out how to configure a box spread, BOXS is another ticker. There are some thoughts around this in the community. Some says, oh, this is illegal or whatnot. But if you, I mean, this got a decent asset under management. So a lot of people are actually doing this. Something on equities and thematic plays. US large cap R&D leaders ETF. I didn't even know that such an ETF exists. So LRND. So let's search for ETF database LRND. So basically what this does is, and it's only 14 bips, so it's not that expensive. 14 bips is, I mean, I'll be okay to pay 14 bips. But this is an ETF which comprise of companies which heavily invest in R&D and CapEx. The thesis is if you are investing more in R&D, that company does better in long term. Right. So if you want to look at if you subscribe to that theme or thesis, here's a company in which you can just get exposure to companies that spend a lot more on R&D. Another ETF. Again, I don't own any one of these in my portfolio just yet. And is, where did we go? Crossover ETF. I think I've heard of this ETF before. But as you guys know, there's been a lot of discussion around private equity and private credit, allowing retail investors to get exposure to these fancy investment vehicles. And now there is an ETF which could allow you to do it. So this holds public equity but can invest up to 15% in private equity assets, right? So this generally stays, I guess, sleepy. But let me just look at ETFDB if we can. Where do you search for it? Let's say XOVR. There wasn't much action into this in terms of asset under management until they talked about that they're getting bought a stake through an SPV into SpaceX. Then I think this AUM started to shoot up. Maybe let's say, well, how much is the AUM right now? It's about 75 bips. It is expensive. But then if you want exposure to SpaceX, you got to pay that. It's almost more than $1 billion, which is good. So this crossover, again, 15% of their portfolio is in illiquid private equity assets. This is funny. Turtle Capital, and if you follow ETF, Turtle Capital always come with some of those wackiest ETFs, right? So this is a government grift ETF. It's not launched yet, but the thesis or in the prospectus, what they're saying is they will intend to invest in companies with strong government political ties or those that are favored by government trading and spending. Basically, try to capitalize on maybe corruption or try to capitalize on not so above board practices of government, right? So you could benefit from, rather than complaining, saying, "Oh, those Congress men and women are benefiting and investing in these companies and all that stuff." Whatever. You get the wind. There is an ETF now. You can get exposure to whenever this launch. We don't know whether it will launch or not. When will it? But GRFT. You want that? Take a note of this one. But this has definitely got some chuckle out of it. Another, see, total capital, another weird ETF of UFOD, which is AI powered. So there will be some AI model behind it, which makes me a little scary anyway to start with. But what is gonna, again, they'll invest in the companies that are likely to benefit from reverse engineering of alien technologies. And now I think this is based on the theme. Thesis is that Trump administration is going to declassify some of those files that have been buried inside government archives, which are around UFO disclosures, right? We don't know what's in Area 51. Some say that there have been UFOs, that there have been aliens that were captured, and US government ran some experiments on that. There is some alien technologies. There are some, maybe some alien spaceships that have been captured and kept in Area 51. We have no idea. Uh, some of those were some files were declassified in 2011, and we got to know some of those when through that book. It was an interesting book if you want to read Area 51. And now I think this whole theme of this ETF is based on Trump administration is going to declassify some of the technologies. And there will be companies that they want to benefit from that alien technology. First of all, this itself is too far-fetched an idea. And then there are an AI which will pick up those companies. I don't even know what's going to happen, but I'm sure the expense fee will be huge. And if the market continues to stay bullish, we will see a lot of retail investors moving far and on the risk curve and trying to invest in these. I shouldn't use the word, but it is a crap ETFs. Hey, but it is a it's capital market. Buyer beware. Do your own due diligence. I'm I'm telling you, this is a snake oil. Now, if you want to buy it, go ahead and buy it. Right? UFOD. Anyone interested in UFOD? Do you want to invest in alien technology? I don't even know what the heck does that even mean. Uh, Another new ticker on Pictet. I don't know. First time I'm hearing this issuer. Cleaner Planet ETF. Right? 70 bips. Basically ESG focused on clean energy. But this is again 70 bips. Like I would consider as a usury expense ratio. And this theme is currently, as you guys know, it's out of hook. All those clean energy ETFs, what is BCLN, right? All those ETFs so far has been out of favor with this new administration coming in. This is an example of things that you should not invest in. Right? Looking at the next one, international VXUS. I don't think it needs any explanation. We already talked about it. Markets outside ex-US, markets other than US have done much better. So keep an eye on VXUS if you're interested in investing or interested in knowing how the other markets outside US are performing. Rather than trying to get an exposure into all individual markets, VXUS will provide you a combined exposure. You can just buy VXUS and get exposure to multiple markets. I don't own this, but interested. Very cheap, right? And let's see what holdings do they have. TSM, which is your Taiwanese, Tencent takes you to China, ASML takes you to Netherlands, Alibaba takes you to China, Korea, AstraZeneca Europe, Roche Europe, Nestle in Europe, SAP Germany, HSBC. So these companies that are majority of the revenue are headquartered outside of the US. I don't think it's majority of the revenue outside US, but these are headquartered outside US. Because I think, if I'm not wrong, TSM majority revenue still comes from US based companies. So if US based companies don't do good, I don't know how TSM gonna do. So there's always some gotcha. So you always go and look at the holdings. Just don't go by the names. Because I've seen in some cases the name is different, and when you look at the holdings, you figure out what the heck is this? Why did it this stock or this company is under this ETF? Anyway, again, continuing on the theme of outside of US, OTGL. This product exposure to Latin America. And basically, the whole idea around this ETF is we are seeing, especially at least a lot of elections, and now it looks like today, U.S. government bombing basically Venezuela. So a lot of even in Argentina and other countries, a lot of pro-business governments are coming in, are coming in power, and this ETF basically is to get benefit advantage of that trend, that we have a more pro-business governments will be getting power in Latin America. That should bode well for the businesses that are operating in that region. I don't like this huge expense ratio, but if there is no other way or other ETF, sorry, it is what it is. So you got these Latin America companies. We got a Walmart of Mexico in here. But I'm surprised to not see Mercado Libre in this, which is one of a big market company from Latin America. I think it's bigger than Nu. But yeah, a lot of exposure to companies from Latin America. And if we have more pro-business governments, this company should benefit. And this ETF is trying to cash in on that theme. Now looking at sector specific or commodities, cannabis ETF. Again, there are many ETFs on cannabis. I think MJ is another one. This is again basically trying to cash in on the theme of if we eventually move towards reclassifying marijuana as a not as a that restricted drug. I forgot the classification. I've not touched this sector for last 3-4 years, but currently marijuana is classified as those as same as heroin, and there have been talks in this administration again that maybe through an executive order they're gonna reclassify it. If it is just get reclassified away from Schedule 1 drug, there are a lot of tailwinds that some of those companies will have, because if you are trading in marijuana, if you are a company that deals in marijuana, you don't have access, you don't basically get the same tax breaks like some of the other businesses get. You don't have access to the same banking infrastructure that other businesses have. So these companies have a much higher cost of operations, and doing business is very, very difficult. But if it gets reclassified and is not considered as a Schedule 1 drug, you should see that these companies be able to improve their margins by a lot, right? And of course, it will become much easier in terms of the growth of the end product itself. But even if, I mean, that's one aspect, that the consumption will grow, you can freely move it around, interstate and all that stuff if it gets declassified at a federal level. But other than that, on that they'll have a lot of will be much better from an operation perspective for their businesses. This ETF and try to cash in on that. Home construction ETF, ITB, XHB is another home builders ETF. Again, this is a sentiment barometer for housing market. If we get interest rate cuts, which we are hoping to get, Fed is saying another what 2 to 3 cuts, and if 10-year goes down, and if mortgage goes down, we should see housing market improve, and ITB, XHB could be some of those ETFs. This is on the crypto side. I think there is another one on the crypto, sorry, from Bitwise, which is, but this ETF I like better than the Bitwise is the many of those who are invested in crypto economy generally have Bitcoin as their top holdings, right? Unless you are like degens and try to do trying playing only in the meme coins. Most of the serious players in the crypto economy have Bitcoin as their top holdings. And now majority of the ETFs, like not individual ones, but the index type of ETFs, like Bitwise came up with theirs, have Bitcoin as their top holding. But this one is excluding Bitcoin, right? So if you're already have exposure to Bitcoin, but you want to get exposure to other cryptos, but buying a ETF, other ETF gives you exposure, more exposure to Bitcoin, you may want to look into this one. This is from 21 shares. It's a pretty reliable issuer from Europe. They also had, I think, 21 shares and ARK Invest, Cathy Wood. They have their ETF ARK, whatever that Bitcoin ETF is, I forgot. I think ARKB. So now they're coming with their own individual ones, which is XBTC. Basically, it will give you exposure to top cryptocurrencies, not Bitcoin. Right. A few more. Continue. Give me some feedback. Continue. Useful, not useful. Otherwise, we'll skip. No?
No.
Most of them are new issues and they have not really shown whether they are able to provide you a good return or not. I'm not interested in these.
So that's why just keep it on your radar. I think the more important is to understand the theme, and then see if you want to take an exposure or not. Buff. Now these will be for those buffer ETFs. We talked about buffer stuff. It became very popular in 2023. We started to see these emergence of these buffer ETFs. They generally have a higher expense ratios, but will basically give you they will use basically do a collar against the S&P 500 and will protect your portfolio beyond a certain percentage loss. Let's say first 10% loss is yours and you are protected beyond it, right? So, and if you're not are actively managing your portfolio, you don't want to do color options by on your own, or buy put options, sell covered calls and all that stuff. One way is you can do buy these buffered ETFs. So a lot of annuity companies sell these buffered instruments. So this is an ETF called BUFF. The difference is it's a laddered buffer ETF. So basically it will continue to manage your downside protection, and it'll have a rolling expiration dates. So you don't have to bother about, okay, this is going to expire, right? So it will continue to roll forward and manage your 10% exposure. I don't know you'll have to read through the prospectus to see what how much of the upside you're giving up, and what's the downside protection you're getting. Right. This is a managed futures strategy ETF. It is designed to provide uncorrelated returns. So this is recommended as a portfolio diversify to hold before market hits. So you really have to time it. You never know when the market will hit, it will go down and the wall will explode. But this is to be, you should get an exposure if you really want in this prior to market hit. Right? Again, the idea is to probably they make use some futures to protect your portfolio. I don't know. This is return stacked bonds and managed futures. So we are getting into more and more exotic instruments now. These are all using derivatives and futures.
And there is no equity in that.
No, this is no equity. This is, I think, bonds and the futures. So if you have this gives you exposure to manage future strategy on top of your core S&P portfolio. And 2x leverage micro cap. I don't even know why one should even buy this, right? But it is what people want to buy leveraged ones, even though it's most of these turned out to be horrible instrument unless you're able to time the markets. But who cares? If people are willing to buy it, issuers will sell it to you. But what caught my interest is SPYM. I did not know. I did not hear about it. And look at it. It's only 2 pips fee. So if on a retirement portfolio, I mean, if you're not doing any fancy stuff like selling covered calls or anything, if you're just holding SPY or let's say VOO, what's the WOO's expense ratio? Which is S&P 500 ETF. You're still giving 3 basis points. So I was surprised by this, that there is something called SPYM. And let's see. Why would someone not take SPYM and pay only 2 basis points? But I'm assuming the holdings are same as SPY. Let's check that. Seven 7.72, 6.84, 6.14. Almost same.
Vivek, is that direct indexing? Maybe not. I mean, they're
No.
talking about new phenomenon, direct indexing, where you can invest in index fund and maybe customize index fund as well.
No, this is not direct indexing. This is mini. Let's see what it says. This says it. I think it's a mini S&P. Like if you can't invest in $600 product, I mean now because we are fractional investing, there is no reason not to get exposure. But if you don't want, because if it's $600 and you feel like, I mean, we have a unit bias, right? I at least want to hold 1 unit of it, right, or 10 units of it. SPYM is available at $80. Right. And of course, I don't think it's a lot of a liquidity in it, but you don't care. If you're not trading in and out of it, you don't care about the liquidity. You didn't care. I mean, Ashwin says option activity. You don't care about whether it's an active option market or not in this or not. SPY has got a very deep options market. But if you are just buying and holding SPY or VOO in your portfolio, and SPY expense ratio is, I think, 7 basis points.
2 basis point and nothing. Expense ratios. I mean, you're just getting direct exposure to index.
And so SPY expense ratio is like 9 basis points.
It has 507 as holdings. It has a 507 holdings.
So SPY has 503. This one has 507 holdings.
I'm
I
curious.
think what we I don't even know
Stock
when.
analysis has that one.
Okay, so maybe we can compare them. I don't know. Let's go to Google Finance and compare the return. I don't know how old this is, but it was the first time that I actually heard about it in that podcast. So let's say 5 year compared to SPY.
So you made a comment about liquidity. If this is just an ETF on the 500 or whatever of the companies, why would there be an issue with liquidity? I'm not quite sure I understand that.
No, liquidity means, let's say, I think someone talked about the options activity in terms of the options on this may not be
Okay.
very liquid market. So if you are buying or selling on options, uh,
Okay.
you will be always paying more for a bid ask spread and all that. And I don't even know how deep option market in this. I mean, SPY, the bid ask spread is like just a cent wide, right?
So
But
if you're not doing the options, if you're just doing the fund itself, then there won't be any issues with that,
yeah,
right?
that's why if you're just buy and hold, and what's the downside of it? I mean, I never heard about it, and it's been inception since 2005, and it's got $97 billion, and it's from the same issuer, which is State Street, so this is not gonna go belly up. Now I'm seriously thinking of, let's say I have SPY in my retirement portfolio, and I don't have any tax implications. Why should I not switch to SPYM and save 7 basis points of fee? Someone please tell me what's the downside of it. I mean, it's the first time I heard about it. I did not even know.
Downside, but SPY, if you have in your retirement, you can at least do some calls, right? Covered calls or something else. But this
If
one,
you are doing, I generally don't touch my retirement one.
yeah,
But if you, I'm assuming that you're not actually trading on retirement side, then what's
that's
the downside of this? Let's say it's only for buy and hold investors. What's the downside?
So just to be clear, right, the difference between this and the other one is just 1 basis point, right? But obviously, if it's a big chunk over time, that can add up.
No, it's not one. I think SPY is 0.09 at least. This one is
Thought it
something.
was 0.03 on VOO, right?
Oh, VOO is 0.03. Yes. Yes.
Right.
VOO it is 0.03.
Yeah. So it's interesting then, is why would Spider, I mean, I think it's the same company, right?
Yeah, but I think SPY can charge it because this is the most liquid in terms of options markets, and there's a big futures on SPX and all that. So they can get away by charging 9 basis points uh, on that. Because there's a lot of other stuff that's built on SPY. But if you're not even dealing with options and all that stuff and holding SPY, SPYM seems to be better. And as compared to Woo, it's only 1 basis point. So it might not be worth that effort trying to get 1 basis point. Right? But think about it.
Yeah, but I agree with you, right? I mean, compared to this one, that's a big difference. And I guess what you just said is correct, which is if you are interested in the options and kind of leveraging this to do that, then I guess you're paying higher on the expense fees, but you have smaller bid spreads and more, a chance to make money that way. But if you are just buying and holding, then go for the lowest costs, which
Exactly.
can be either the other one or Woo. I mean, just right. So
Yep. Yep. That's true. I mean, the reason why I don't hold any of these Vanguard ETFs are because they're horrible. I mean, they don't have much liquidity on the option side. But if you're holding Woo, yeah, might stick to it. It's got only 3 basis points. And maybe they might have reduced this expense ratio, maybe to attract more AUM from the Woo community.
I'm curious, but with Woo, I believe is also very huge, right? So
That's the biggest one.
right. So I'm curious why there isn't liquidity there. If you've got that much.
It doesn't trade it on options. On options market, there's not liquidity.
But I'm curious, if it has options, why would, and again, sorry, I don't mean to sidetrack, but just curious, if you've got a huge thing there, why would, individuals or institutions want to do options in others and not in that one, right? Just curious.
Maybe they, I mean, it also depends on market makers and how much they want to also, what's the vanguard relationship with the market makers who are making market in Wu and all that stuff, right? So I don't understand how the whole plumbing works. Maybe someone who's from that background or worked in capital markets can tell us, let's say when you bring up a security for an options, how the whole plumbing works, how do you get a market makers, how do you make sure that as a market maker you can create and destroy the units of these ETFs and all that, and how the whole stuff works. There is, I think, more than just the AUM that determine the capital markets and the efficiency of it. I don't know, but that's how it is. So Alfred says, I think dividend wise also it is same. Performance wise, if we compare, I mean, I compare both of them, right? It's almost same in terms of capital appreciation. Dividend wise is same. So I think if anyone here is still holding SPY in the retirement portfolio where you don't have any tax implications to swap SPY to SPYM, I don't see any reason of not doing it. If you are just buy and hold. But if you're trading on options, it's a different discussion altogether. But this is something which was completely new to me. I didn't even know about this. Anyway, so hopefully at least there is one ticker which I really like. Oh my God, we should be exploring it a bit more, right? Yeah, I don't want to pay 9 basis points, but this is, and I think we have a ratio of 1:7 in terms of a pricing. It's a, or what's that? Let's say SPY is at, this is 80 and 683. Let's see, that makes it 683.19 divided by, oh, okay, 17, it's okay, 80.39, 8.5. If the ratio is always maintained at 8.5, I'm seriously thinking of now swapping my retirement. You do what's best for you, but 7 basis points difference is big attraction. Anyway, all right, so these were some of the ETFs. You may want to keep it on your radar. Just watch it. If you get interested, take an exposure, but most of them were the tickers that I never heard before. So I thought I'll come and have that discussion with you guys. All right, what did I buy or sell this week? Again, not a recommendation, but want to be a little transparent in terms of, because we talk about stocks all the time. So want to be transparent in terms of what I am buying or selling. So I had a Jan expiration short put spread, which was like deep in the money and could have gotten assigned any time because the extrinsic value was very less. So I basically closed the put spread and I bought shares of Uber. That's the only shares I added in my portfolio. Okay. So I'm seeing some comment. Alfred saying is SPYM will be great for day trading, lower risk. The per unit, yeah, because the unit number is smaller. Oh, Rajiv says he'll be holding SPYM in Roth for some years, used to be named SPLG. Oh, that's been renamed now? Okay. You should have talked about it earlier, man.
Yeah, I once have went hunting for what's the lowest expense ratio SPY clone and found this.
Yeah. So I think, yeah, you did a great job. You saved all those fee, and looks like it's flown exactly on the SPY performance. Sridhar says the difference is dividend. No, I think someone already looked at the dividend rate. Alfred already said that dividend is same. So I don't know why you're saying in terms of a dividend yield, it is any different. Anyway, you can research more on it, but it's definitely intriguing for me, and I would want to go and figure what's the downside. So far, I haven't found any downside.
I'm curious, you mentioned Uber you picked up, right? Because just the company itself from an investing perspective, why did you pick that?
So Uber, I've been with Uber for, let me figure out when did I first bought Uber. So, and I did a deep dive and I said, this is like undeletable app. It could become an undeletable app. But I looked at Uber in 2019. I think that's when I took first exposure. And then slowly I added to my portfolio. Especially I'm very encouraged by Dara and the new CFO. Name is slipping out from my mind. uh, and how they've turned around the business from a cash burning machine to like making $4 billion cash flow positive and expanding the business from just a low margin uh, taxi mobility. They moved into delivery side. I mean, they reinvented themselves during COVID. And Dara talks a lot about moving into adjacencies. So I don't even know. They could actually get into a lot more other businesses that I can't think about right now. I never knew that they're gonna get into having their drivers do AI related work. No, but I think he's open to new ideas, and I do understand the concern which I have on this company is if Tesla comes up with robo taxi and basically drives down all the margins, what's will Uber be impacted? Sure, it will be impacted, but then Uber also forged relationship with all, the biggest AV autonomous vehicle software providers across the world. And they may still become a platform in terms of providing the managing the supply and the demand, basically managing the marketplace. And then the taxis, etc., can be spun out as a separate business. Dara has talked about it that in a long term, it could just become like a Marriott's and the Hiltons of the world, wherein the physical assets, which are heavy on the balance sheet, they are like REITs. And similarly, these fleets could be owned by those, let's say, some private equity company or those company which like invest in REITs and all that, who manages those, have a big balance sheets, and Uber could just become like provider of a software, just like Marriott, Hilton. Many of them, they don't own their properties. Properties are managed by REITs. They just provide the branding and whatever, their business specific processes. So long term, it could be that. So I'm still bullish about it. I mean, more around the management side because they have turned around their business and they have become a lot more shareholder friendly, like not investing or not growing just for the heck of growing, want to grow with it, also provide a cash flow. So I like it. I mean, I review Uber every quarter, and so far, from a business perspective, there's nothing that I'm huge concerned about. So that was my thesis. But I invested way back in 2019. I think when I heard about on one of the podcasts around undeletable app, and then we talked about it. In 2020 is when I started this meetup, and we talked about Uber and gave you my thesis. So that's my thesis. All right. So this is how the portfolio top 15 looks like at the end of December. I'll share again at the end of November. Oh, sorry, again at the end of January. So nothing much has changed. In terms of the leaderboard, I think only one swap that I see is IWM. TSM has become bigger Then IWM over this month. Earlier, IWM was in top 15. Now it is not. It's been replaced by TSM. So I'll give you a minute to maybe view it, ask any questions that you have. Otherwise, wait for the next month.
So is this an overall portfolio mix or just taxable account? And
No, this is overall. This is overall.
Mhm.
It includes so the big chunk, this is coming from my retirement accounts. That's why I'm wondering, dude, I'm paying like, what, 9 basis points? Right? Some of them I own, probably both in retirement as well as on my regular trading account. Some of them are only in retirement account, but this is like overall across my all stock portfolios.
But if the return is the same in both the SPY and SPYM, does it make any difference with the 7 basis points that you're talking about? The end result reported very similar to each other.
No, but that end result is free of fees, right? So they will, so
Is
they
it
will
free
also,
of, is it free of the,
yeah, so this is just the capital appreciation. But I think if you net out the fee, I'm assuming this is pre-fee.
you're not paying
It's
separate
net
fee?
of managed, management fees.
Is this net?
Yeah, the price quoted is always like offset with dividends and capital gains and any expenses.
And that's what I thought too.
No, I don't think Google does a net of dividends, because if you look at Google last 1 year, I don't know, I can go to 1 year because it was showing 16.35%. Whereas if you add dividends to it, it comes out to be 17 point some percent. So Google Finance doesn't show impact including dividends.
I think I use Yahoo Finance that way. Yeah.
Okay. Yeah. So I don't know. I mean, if it is net, if net of fee is the same result, again, there's a data point which I may have to explore. If net of fee is the same result, then who cares?
Hey, Vivek, on your pie, you have SCHD and you have IC. You told me you have ICSH, right? So what is your purpose of the SCHD right here?
ACHD is for me one way to get all exposure to all the companies that have generate enough earnings and have a so that they can pay dividends. I'm not hungry for dividends, but by proxy, by the fact that they're able to pay some good dividends, it means I'm buying the companies that are profitable and have been generating enough earnings. So what I have seen in the history is when markets turn bearish, ACHD performs better than SPY, because now you're holding the companies that actually have a businesses that generate good earnings. Whereas in terms of SPY, the business may not be profitable, but it is enjoying a tailwind of AI or EV or cannabis or whatever, right? And once the market turns around, those stocks fall much faster because were not good business, just that currently momentum is driving them. So ACHD, probably I'm assuming, will give me some protection when markets deteriorates.
So this is more protection for you than the other one which you have, right? I think it's ICSH.
ICSH is like a parking cash. I'm waiting for
Okay.
opportunities to deploy, but I also need to pay bills. So I'm moving money in, ICSH, uh, either to wait for when the market, that fear and greed turns fear, extreme fear. I'll sell back some
I
ICSH
see.
and, buy some stock. So that's just parking cash.
Okay.
Right?
So I noticed you have Shopify. In the last few weeks, it's come down substantially. What's your opinion on fundamentals of Shop?
I think I'm still bullish, but I don't care what happened in the last few weeks. And I didn't even check that anything has materially changed in Shopify in last few weeks. I mean, I'll wait for the earning results to show up. In next quarterly earnings, I'll review it. But
Yeah, relative to the AI trade, I guess Shopify has underperformed.
That's fine with me.
Okay.
Again, I don't want to be always try to get the best return, because then I will also be putting my portfolio on the mercy of the current trend, which is just going, and then if 100% is based on that trend, I don't know when the trend will go out of favor. And I'm okay to have lesser than the best returns, right? So, and I do like SCHD hasn't done much this year. I mean, if you look at SCHD performance wise, I just hate to look at it. But hey, it will give me some protect SCH. Dang it. Hold on. Let's go last 1 year. It doesn't matter. It's only 1%. It didn't do anything for 2025.
So again, what is your so okay? If I wanted, have you looked at something called FLOT, which is basically like in I, I guess rate sensitive paper.
It's a floating bond rate ETF.
Right, but very short term. So I'm wondering, like, so your purpose again for SCHD is to get dividend growth? Is that what you're
No,
saying?
no, no, no. It also has a good. So it also has. If you look at SCSD, it holds some great companies. Just that those companies for last 2025 has been out of favor, because everything has been driven by AI. And if you look at these companies, I don't own individual these companies. Let's say Bristol Myers, Merck, ConocoPhillips, Lockheed Martin. These are some big businesses.
So I'm looking at the Morningstar style box. It says large cap value. That's what you're doing essentially.
These are the large cap.
Value.
But it's a large cap blended equities, whatever. It's a good dividend equity ETF. And the fact that they're able to pay dividend means they have a businesses that generate enough earnings. Right?
Okay, it's like IVE, which is what I track with.
Maybe.
IVE is
And my idea is because it's an expense. I looked at a few. There's a Noble NOBL, which has got dividend aristocrats. There are a few. I looked at it, and I've been buying this for like 7, 8 years. That time I looked at some of the ETFs which have hold big solid companies with decent earnings, and I have been paying dividends for 20 years, because those companies just doesn't go immediately, they don't just crash suddenly, right? And then I looked at it. SCHD had the lowest expense ratio, and at that point of a time it has a good option volume as well. Unfortunately, after they did a split, the options have become much wider. Earlier it used to be like $70, $80 the option. It was doing playing options on it was much easier. I will just sell a put, wait for it to get a sun, all that stuff. After they did a split, um, not that great, but hey, I still want to hold it in my portfolio, and it's got like a 6 basis points. The others like NOBL, there are a few more, and I don't remember all of them because now I think it's been come on, it's been many years. But that's where I searched for a dividend aristocrats ETF. Noble had like 35 basis points.
Is SCHD monthly or quarterly?
So it gives dividend.
Yeah,
I think it's quarterly.
no quarterly. Okay.
Let me just search for SCHD. Yes, it's quarterly dividend.
But
Again,
you're getting paid monthly already from the ICSH, right?
I don't know. ICSH pays monthly. I
I
never
think it's
looked at
monthly. Yeah, it's monthly.
it. I mean, again, my main idea is not to get the dividend, but this gives me exposure to some of the solid companies, which also pays dividend. I mean, and these companies are not gonna, take a decisions just to get a huge growth, which could impact the dividends. Maybe they're gonna be a little more prudent in their capital allocation, not gonna, take some stupid decisions because they want to maintain the dividend. So it gives me a lot of other factors in terms of how the management will think about business, which I want to hold in my portfolio. Because if you look at it, the rest of the portfolio, is already driven by very concentrated theme, right? Meta, Google, QQQ, Apple, Microsoft. So
Yeah,
that's
you're getting dividends in all this big Mac 7 right here, right? I mean, some of them does, right? Apple,
they give
right?
like a cent in a dividend. Who cares? And I think the reason why they gave a dividend is not because they want to return the capital, because that makes them eligible for some of those funds whose mandate says that they can only invest in dividend paying companies. So again, these are the games which company will play because now they can attract that investor basis. Because if you are approaching a particular fund and I can't invest in Meta because Meta doesn't pay dividend, and my mandate is I'm a, let's say, income fund, so I have to invest only in the companies that pay dividend. I don't care how less dividend you may be, and now suddenly you can now invest in Meta. So Meta has
So
a bigger shareholder basis.
so if I read this pie correctly, right, you say end of November, for example, Melly is number 3. End of December, Melly is number 2. So that means you have increased shares in Melly?
Or the Google prices had come down either way.
Okay.
Both could be possible.
Okay.
Yeah.
Vivek, I have a question.
Go ahead.
From this portfolio, which stocks or ETFs you have specifically only in retirement? And then why do you have some of them in retirement and why you don't have some of them?
Pi is in retirement. Mel is not. I don't think I have Google in retirement. SEHD is in retirement. Cash is in bank as well as on all my accounts. I mean, cash is some portion of cash is everywhere. QQQ is in retirement. I don't think I have a QQQ or SPY as a units in my trading accounts. Apple is in retirement. I don't think I have it in my trading account. Microsoft I have in both. Shopify I have only in trading account. Nvidia is only in trading account. Amazon is only in trading. Berkshire Hathaway, I think only retirement. I've been selling put spread on Berkshire Hathaway, but never got assigned in retirement in my trading account. If it does, I'll pick up. ASML is only in trading account. TSM is only in trading account. Again, the reason.
If we're interpreting this correctly, sorry, Vivek, I just want to understand. So what you're sharing here is not just stock that you own. These are a mixture of what's in your, like, I don't know, 401ks or trading accounts, and then others which you own.
This is across all my portfolio. If I have a QQQ or SASD, I combine everything together. Retirement, non-retirement, everything all together. SPY is 14.75% of my overall stock portfolio, which includes my trading accounts, which I regular trade on, also includes my retirement account, my wife's retirement account. You can get the household.
And if you
have a view of this, which has
the
like
reason, as you started saying, what's the reason that some of them you have only in your retirement accounts?
I want to so I have more stocks in my non-retirement account because I want to simplify my retirement account. I'll probably will be only want to keep the solid businesses and maybe only ETFs in my retirement account. I still have some stocks which are like crappy, which I added in my retirement account like 6-7 years ago, assuming those will become rocket ships. Everyone learns. And those stocks are like fallen down 60-70%. I become dust. I'll probably clean it up. I want to make sure the retirement account is on an autopilot, having largely just the ETFs or very solid big large cap companies. Everything else which I monitor on daily basis, I want to keep it on my non-retirement account. Other thing is I want to make retirement mostly on an I think I already said like largely ETF and big companies. So most of my retirement still ETFs is composed of ETF, SPY, ACSD, QQQ. That's give the maximum one.
And you replace IWM with TSM?
I did not replace. IWM fell off from the top 15.
Okay, the top 15.
This
Okay, I
is the
see.
top
Okay.
15.
Okay.
So the leaderboard changes depending on how the stocks are done. If you look at TSM, Maybe TSM have done better, I think by end of December, let's say TSM.
I'm curious. You said you do more of the mutual funds or ETFs rather in your retirement and more of the active stuff outside. Wouldn't it make more sense to do it the other way from a tax perspective? Because if you're just buying and holding, outside, you don't have to be paying taxes on it. If you're doing a lot of activity, then doing it in your retirement, you're not paying taxes on that until you withdraw, right?
Yeah,
Especially
but when I say activity, I'm mostly around my options, trading around my
right.
positions. In retirement, I can't do certain strategies which I can do on my
Okay.
brokerage.
That's true. They limit how much you can,
Yeah,
what type of
what
things.
I can do on my
Agreed. Yeah.
and also I get a margin in my brokerage account, which I won't. Retirement will be only cash.
Yeah.
So that's a reason.
That's true. Thanks.
The short-term trades in the retirement account will probably you will do much better and do more of the options that you need to do naked in your regular margin account.
Yeah,
Think
but
about it.
yeah, I generally don't want to do a lot of stuff on retirement because I realize the biggest enemy of a portfolio is we ourselves. And I want to make sure that I don't get into a habit of touching my retirement account too often.
I have one question for you because I guess I'm confused on this. So the retirement account that you do, it sounds like you do it self-managed and you pick your stocks versus like invest in a fund, right? Which is like a retirement at this age. Am I correct to assume that?
That is true. That is true. I used to have that what do you have those defined retirement those
The year
funds.
that you retire of a fund.
Yeah. So I used to
Yeah.
have that once I initially started my 401ks, and and then once I moved to IRA, I said, and I became more active in market. So I sold off all those uh, diff, that retirement plans and started buying individual tickers. Yeah, so that's what it
Can I
is.
ask one other thing? And you don't have to answer this, but what percentage of your funds are in the retirement versus actually in the stock market?
I think it is approaching almost half.
Half. Okay, thank you.
Yeah. I would say 55-45%. Cool. All right. Oh, that was the last one. Oh no, we have to. I have to do that option. Maybe we should skip that one, or I can just show that. Won't get into the detail of it, but let's go through what I tweeted on. Can go to the full document. We don't have time. And now this is only the active trading account. This does not include the retirement account. So we just finished 2025, and like I said, I do want to track a lot of stuff. So I tracked on in terms of on my actively trading account. Is it really worthwhile spending time on this? Is it really worth trying to do this option stuff, and all that? Unless I know how I'm doing, I wouldn't know it, right? Maybe it's better to hand over the money to someone. Maybe it's like I told, right? Like there are 4 C's. If I'm not generating cash, but I'm enjoying the whole other process, maybe I should do something else. So I do track these performances. So at the end of 2025, my trading account had what 35%. I'm not the one who's ever gonna get 3-digit performances, and I'm not gonna try for that, right? But I'm happy with what I'm getting. SPY is 16.35, 17% dividend reinvested. My worst month was March, when the portfolio was down 7.68%.
I have a question.
Sorry?
I have a question.
So,
when you say your trading account, so do you day trade? Do you swing trade? Can you elaborate more on
no,
that?
so the accounts on which I generally don't do swing trades. I basically trade options against the position which I want to hold for long. Basically, these are my taxable accounts, all the taxable accounts.
All right. So your trading, you're saying you only do options.
Yes.
You do like naked calls. What kind of
everything? You'll see some of those what strategies I've done. So I'll share in terms of what's the percent of each strategy. It's there down below. Okay. So worst was March. Best performing month was May. Across all my taxable accounts, May was I was up 11%. Drawdowns, and this is where I think the most difficult stuff for investors is. This year, not surprised, we have a 57 new high for portfolio, but it was down almost 28% on the Liberation Day, whatever that day or week. It's not easy to go through those drawdowns. When suddenly you see, especially when you have to pay bills, you see that your portfolio is down 28% from the previous high. It does take a toll. That's why investing is not, it's simple, but it's not easy. You have to go through these drawdowns. Max daily change on 4/9, I think when Trump gave a first hint of, these are the tariffs, we will negotiate, the market was up. That day portfolio was up 17%. And worst daily performance was on Liberation, almost 9% down. Yeah. I closed trade in 70 tickers in 2025. 58 were profitable. Profitable means now these tickers, when I say profitable, is only on the option income, not on capital appreciation. Okay, so this is only on options income. Netted 58 were profitable. Maybe on 12, I didn't make money.
So the 34% for the year gain, is that on a denominator which stayed constantly exposed to equity risk all through the year?
So I think last week I shared the methodology that I use, which takes care of money flowing in and out.
But it was not exposed at all to bond risk or.
This is all my trading portfolio. And I do hold
You don't
TLT.
have bonds, right? Yeah.
I hold TLT. I hold ICSH in my portfolio. It's not just equity. I don't care whether it's equity or what. At the end of the day, it's my overall portfolio, which I actually.
That's pretty good, 35% thing. Congratulations.
And now this is option premiums, net option premium, top 10 tickers. I love IBIT and Palantir because very optionable and decent option incomes on that one. These are the top 10.
Now, hold on one second.
Yeah.
With the 10 profitable tickers, was that including the option or
It is
excluding?
only including the option. It doesn't include capital appreciation.
Okay, got it.
Yeah, it's only the option rates.
Okay.
Right. It's not, let's say Palantir has been a way more profitable because I sold Palantir shares and which I bought at like $10-15 and sold at 150. So it doesn't include any one of those capital. It's only the options income.
So QQQ, you were selling covered calls at 30.
I'll tell you that's a surprising in this one because the market was too much volatile. The lot of calls that I sold on QQQ during the April month, when the market tanked, those become hugely profitable. Right. So I think it's the first year in last 3 years where actually the long-term portfolio, I mean, I had a capital appreciation as well as a positive option income because I use options to a lot of do hedging, and which I'm okay to lose money on hedging, which is what happened in 2024. If I look at my 2024, option income was negative, but that's okay.
But this does not include puts, right? So this is only selling covered calls, but not selling.
Everything. Hold on. I'll come to that. Then, okay, let me jump there, right? So what did I buy or sell? Let's look at this.
Oh, wow.
So majority of my trades were hedging trades. I just try to hedge my portfolio. Like 35%, 1/3 of the trades that I've done are all hedging trades, selling calls, naked calls, call spreads.
Naked calls? Oh.
Yeah, I mean QQQ. I mean, no, don't do naked calls on individual stocks. The QQQs, call spreads on SPX. naked calls on SPY, naked calls on XSP. So these are generally hedging trades. Right? And then short puts, because the market has a tailwind, I think 21% trades were short puts, covered calls, all this. One, I think synthetic stock was, I think, the Jumia one, which I talked about it because I sold the stocks and basically created into a synthetic position. Bought a call, sold a put. I don't think I had any other synthetic stock position. Then some strangles, short call. This would be maybe an individual stock. Hedging, it's basically short calls and all those stuff on indices. Very few ratio spread. I'm not a big calendar guy, so I don't have any calendar. I never understood calendar trades really well. I don't do that. I think I did maybe one or two put spread long. I know, definitely remember Oracle. I think that probably was maybe one or two I done put spread. That's it. So let's go back. The amount of option premium netted, it means at the end of a day, how much money did each of these strategies bring in? Short puts 30K, hedging brought in 15,000, some stuff, blah, blah, blah. Hedgings are only done to manage overall delta of portfolio. I don't look at individual positions. That's the first thing I do is every day I'll comment what my delta is. If it is less, maybe I'll sell some put, naked put. If it is more, I'll sell some naked calls, right? Do callers, do call spreads, etc., etc.
So if you're overall long, right, your delta is probably in the hundreds or maybe in the thousand, right?
Yes, I'm overall long. That's why the overall portfolio has done much better.
So when you say you're doing hedging, I mean the cover call or can you go back to the page where you have the strategy? Yeah, so most of you, when you say hedging right here, what is that particular hedging that you would do for your long positions right here? What does that
Long.
represent?
So no, if I'm doing let's say if I'm doing for individual stocks, that will get covered under short call or covered call. Let's say if
Correct.
I have a Uber, right? And
Uh-huh.
Uber, I sold a call against it.
Yeah, the cover call I understand, but I'm not sure when you say hedging, what does hedging mean
So
from an options perspective right
let
here?
me share you something on.
Or are you
Give you
just
a
buying the opposite?
sample of a trade on hedging. You'll understand.
Yeah. Okay.
He
Let me
has
just.
and sells a strangle.
Strangles.
Uh,
Well,
so
Stringle's on the bottom right there, right? Right
yeah.
above the synthetic right there.
No, so
No,
even
but
though the trade is triangle, in my own classification, I will write it as hedging. And the reason is so that I know what I'm doing from a hedging perspective or not. Okay, so let me just share.
So you double count right here then.
I don't double count. I don't consider them as a. Okay, so hold on. I just took some trade.
So the short string on the bottom is different than hedging right here, right?
So hold on. I don't know how to show up. Okay, so geez. So let's say these are latest one. I sold a SPY 675 put. I'm not classifying under as a short put trade because I wanted to add little bit deltas. I was short on deltas. Okay. 2030. Okay, I closed that on 2030. This one, what I did, I sold put again. My portfolio beta weighted delta was 350 in one particular one. I thought it was low. Let me go where I have actually sold. There we go. Let's say XSP, right? This one, selling short, opening short call to reduce the delta. Because the
okay.
weighted delta was like more than or 1700. I wanted to reduce it. I just sold it. I sold a call, but I'm not classifying it under short call. I'm classifying it as a hedge trade because this is
I
purely
see.
for managing delta.
Okay.
Right. So that's what.
And so I mean, if your overall, so say for example, your overall loan delta says 1,000, right? And then what is your bar per se to say, hey, 1,000 is too much. I'm gonna try and bring it down to 700.
Yeah, so that's more art than science, right? If I see the market, it will be like 7,500. Now I say, oh, I made enough gains already this year. Because my portfolio has gone up. Do I still want to maintain same amount of a deltas? Probably not. I'll reduce it. So that's more of an art. And I also have to
Okay.
see how the market is behaving. So in 2024, I became more bearish because 2023 was great. I think I was like up more than 40% across my portfolios in 2023. 2024, I became very more conservative. I started having less deltas. So in 2025, when I saw this AI tailwind is continuing to grow, I thought, no, I would want to keep higher delta than what I kept in 2024. So this is very individualistic in terms of what deltas you are comfortable with.
So it's interesting your hedging has the highest percentage
Yeah, because
than
those
your
are
short put, right?
because those are the max trades I do. Most of the trades that I do are most of the hedging trades. I just want to hedge my portfolio because market has a tailwind, upside tailwind anyway. I just want to make sure that if market goes south, I just don't, I lose less. And it does mean that I have to sacrifice some of my returns. It's okay. I'm okay with not making 50%. I'm okay with making 20%. But what I don't want to do is that the market is down 20% and I'm down 40%. Then I can't pay my bills. So that's the problem.
You have an IB short right there. What does the IB short mean?
Iron butterfly.
Oh, iron butterfly. Okay.
So I don't do covered call selling, but I've heard big kind of noise about it. So supposing I have a stock portfolio, what would you say would be the expected percentage gain by selling 30 delta calls on all stocks all the time?
So when I took a decision of going, leaving job and focusing only on investing, my idea was that by selling option premium, if I want to scale my trade and sell option premium, I haven't scaled it in 2025. You will see in buying power. I think I can generate just from an option premium at the start of my year, I can generate maybe around 7 to 10% of my portfolio value just in a netting in the premium, right? And when I realized, I think, can I run my household in that? It was a stupid decision. It was an aggressive decision, but I took it and I say, okay, let me just focus completely on investing. So I still feel that if, I'll scale the capital, let's say if the markets goes, wall is little higher, just on a premium selling, we can get a, 5 to 7% or maybe become more aggressive up to 10% of your portfolio value as a option icing.
And so this is based on week expirations or 4 week expirations?
I generally do on except the hedging trades, which is on a weekly. I have like every week I have hedgings for next 3 to 4 weeks. Most of my regular trades will be monthly. Like I've started building my February portfolio, but there are some tickers on which I will also do like 2 weeks out. Like IBT is there because they have a decent liquidity. It also depends on where we have a higher liquidity, right? Some of the tickers like, and I hate to say it, Mercado Libre, like such a big, wider bid-ask spread. I just haven't been able to do much option trades against it. ASML, not been able to do much option trades against it. But Palantir, even though I sold a lot of my Palantir stocks, but I'm still very active on an option side because I got a much depth and I have like 2 weeks out covered calls on Palantir still. So it depends on if I ever find a liquidity, then I'll do. There are very few in which I'll do, let's say, weekly or 2 weeks out, except the hedging ones. It will be mostly monthly, the regular monthly expiration.
Nice, very nice.
All right. I traded for 248 days out of a 261 business. I mean, I don't know whether the market was open for 261 days or not. I just used the Google formula net working days. I'll be very clear. But I traded on 248 days. Okay. So and 168 winning days. which is basically if I close some trade, these are all trades that have been closed, right? Buying power used, which I keep an active eye on this one in terms of it tells me how much I have leveraged or how big I've gone in terms of selling premium and all that stuff. Max buying power, I track it at the end of a month. It was in February. I had consumed 33% buying power because we had a good years and I was like starting, I was a little bit skittish. I didn't want to go big in terms of selling a lot of premium, and that is why I didn't achieve like 10% on a option premium, but that's okay because overall portfolio has grown. But I think I'm okay to be that conservative. It's fine.
Hey, when you do the delta, right? In TOS, do you beta weight against SPX?
When you do portfolio beta weighted delta, right? So the
If you look at
delta
your position statement, for example, right? For example, I think I'm overall long, I have a couple thousand long delta, but I know if I click beta weight against SPX, right, that number drop
yeah,
considerably,
so
right?
I beta weight. So when I do hedging trade, those based on a beta weight SPY beta weighted values.
Okay.
I weight beta weighted to SPY. Sometimes I debated should I beta weight it to QQQ, but then I realized I have a big hold. My biggest holding is SPY. Then I have SCHDs. Then I also have a Berkshire Hathaways, and then even some of the individual tickers that I hold are also part of SPY. So I realized I should beta weight to SPY. That could still debate, but I like to beta weight against SPY. So when I look at the overall deltas, before I do delta hedging trades, I look at what's my beta weighted SPY of portfolio is. And if I find it more than what I want it to be, you basically do delta reduction trades.
And essentially you say that's more of an art, right? There's no
Yeah, I think everyone
what's
has to become a comfortable with one number.
okay.
And there have been some years where I've become too more conservative because, oh my God, I'm already up like 20%. How much market can go? So I started to reduce my deltas and market went up higher or it didn't go down and I could have made 25%. So it all depends. I think that's more of for me personally, that's more of a art. And I have to see, what do I think? Again, don't have a crystal ball, no one has. But if I think there is a tailwind on an upside, there are, on the market, maybe overall more business friendly environment, then maybe I'll keep higher delta.
So you say you're up to what, 39%? Is it by
No,
what month?
no, I think this is what
35%, right? So say for example, say by July, you're already up 35%. Then then you want to contain your savings percent. I mean, you want to contain your profit. Then you would go less. Would you go more or go less?
if I'm July, I'm up 30%. If I still have a huge deltas, I would actually start to reduce my deltas.
And you use think or swim for all of these calculations, like delta, whatever you guys are talking about, beta weighted.
Beta weighted think or swim, yeah, you can just put think or swim. So for example, you come
And
here.
when you do this day by day analysis, like you have days based.
No, I don't have a day by. So when I put a trade, I journal it and said, when I did this trade, my beta weighted portfolio beta weighted delta was this amount.
So you track your days yourself, or is there some software like winning days?
No, I track my trades myself, right? So you can see. I mean, I've shared that, right? So you can see those. Not the hedging trades, but all other trades you can see on the website. And I also do the same uh, comments for my hedging trades. Only additional information on the hedging trades would be, okay, why I did this, what was my delta at that point of a time, because later on I'll forget. So I have to remember, okay, what was my delta, what was I thinking that part of a time. And oh, come on, I'm just trying to get to the website. Okay, let me just show you. So I just basically keep out my own journal and track what my delta was. But you can get that information from Thinkorswim. Your portfolio beta VD delta. Okay, let me just see. Okay. Where is it? View all trades. Oh, you don't have last 3 months because this year has just started, right? So I basically have a new sheet for my this year, right? So I basically put a memo on why I did this. Say Intel, I did a delta neutral strangle. I own long shares, so I'm covered. Palantir closed a covered call, opening another one at 60 delta at 175. So I do journal my trade. What I did on Netflix was synthetic long stock 90 delta position. This was, I think, a box spread. So except hedging trades, I think all other trades are here, and these are all my trades which are in my 2026 journal. So similarly for hedging trade, I'll put a comment and say, hey, this is my portfolio beta VD delta is. So this is no rocket science. It's just that when when you decide that you have to run it as a business, you need to have your books ready. You need to track the transactions. Consider it that way.
The delta that you have posted, that is on the individual shares, not the entire portfolio.
So yeah, these are like individual shares, right?
Right.
Yeah. This one, like Iron Condor TSM, I just did Friday. It was a balance, but it wasn't actually balanced. It was a very slightly bearish till a -5 delta on the Iron Condor. Right.
I just wanted to clarify for the
Yeah.
rest of
So these were individual shares. I sold a put spread near the short put was near 20 delta. And then I also sold a covered call. I think I had sold a covered call. I had a covered call against 16 delta, and then the stock went higher, so I lost deltas. So I sold a put spread against my covered call, just to get back to my 16 delta trade. That's what it is. Alrighty. Yeah, if you're ever serious about a business, we have to track all the transactions. What else? Okay, now this is the days held. This is all strategies. This basically tracks when I open the trade and when I close the trade, what's the difference between the closing date and the opening date. Majority comes to be 5 to 10, 10 to 15. It is because there's gets skewed by a hedging trades, which are, are short-term trades. Otherwise, I don't have a excluding hedging, but most of my hedge trades are very like 3 weeks out, and then market doesn't move much, and then I'll close it because I hit profit target, open another one for 2 weeks out and
Do
3
you
weeks.
cover calls weekly or depends?
The regular cover calls against my individual stocks.
Yeah.
Palantir, IBITs probably are 2 weeks out. Most of
Okay.
them are otherwise monthly. So right now I'm doing, let's say, February ones. So February is a special case because right now some of them have earnings. So instead of doing, let's say, instead of doing 20th February, which is regular monthly expiration, but if there is a earnings coming up on 18th, 19th, I might want to do 13th February, and just to avoid earnings. But otherwise, it's the regular monthly expiration is what I do.
Yeah.
Cool.
Vivek, is y-axis the percentage of maximum profit in that
No,
trade?
this is the number of trades. So 40% of my trades, these are hedge trades I closed after holding 5 to 10 days.
So let me ask you one question. So there's something called return on capital invested, which you have shown, and what I consider return on time invested. Let's say you were given 4 or 8 extra hours every trading day. how much more return could you generate? Or is it worth giving up a full-time job for me to go and start doing
I
this?
don't think I can generate much because I don't spend too much time on actual trading. So my schedule is like I'll sit around 8 o'clock and probably 8 to 9, 9:30. I'll look at portfolio and see, okay, some trades are auto closed. I'll just update my journal and see, okay, what's happened in the market and all that. So around 10 o'clock, I then leave and I start studying the stuff. If I'm reading a book, I'll continue. I'll go through the newspapers. I'll go through earning reports and all that stuff. And then I'll come back for actual doing trades around 11, 11, 15, 11:30. And then I'll trade for one more hour, see, okay, what happened in the market, if some that got closed or not. If not, okay, then I'll do it. And my idea is to get away from my computer at 12:30 so that I don't do stupid stuff in the last 30 minutes of market jump up and down. Haven't been successful, but this is my generally idea is I want to spend a lot more time in educating myself on learning about companies than actual trading. Have there been days where I have spent more time? Of course, if the VIX is higher, there might be more opportunity. And there have been days wherein I'm like, I don't want to do anything today, and I went out for a hike and probably only came back at 11 o'clock and then looked at a portfolio and did some trades.
So your trading signal generation is not dependent on new arrival of information.
Yeah.
For example,
If I'm
investment
holding, my
industry,
holding period is like 5 years, 6 years.
it's
Today
more based on
doesn't matter anything.
quant stuff like 30 delta and regularly using a mechanism called covered calls and so on. So you put in looks like stop losses for them to trigger automatically. Is that?
No, I had never used stop loss.
Or you just put limit orders which close. Okay.
No. I don't put a limit. Options never do. Option, I'll just go and basically do a limit order based on what's trading right now. I've not automated it to an extent wherein if my previous trade get closed, the next one should automatically trigger at 30 delta.
But why do you say auto closed then? How do you decide your
I
price?
put my GTC closing order so that I don't have to track. It's a GTC closing order. I'd never have a GTC opening order.
Oh, okay.
So that's like I'm like auto close because hey, I got up in the morning, then after I got my coffee, I see okay, 3, 4 trades have closed automatically because that GTC closing order at a profit target, right? I know if I'm selling an option, I can maximum make X amount of dollars. And then I have a profit target. I've upped my profit target in 2025. If I am making 60% of max, it should auto close it.
So you don't do trailing stop based profit taking, but you instead give a straight GTC.
Yeah, with GTC, yeah.
Hey, question about your, say for example, I know Mercado Libre, you've been holding them for 5, 6 years, right? Say your cost basis is 1,000 or maybe say 500. I don't know what is it now, maybe say it's 2,000. If you sell cover call on that, would you sell like a 20 delta or 10 delta just to get some profit, or would you sell around 30 delta?
Mercado Libre, I won't sell around 30 delta because hey, 30 delta is too close. I would sell maybe 20 deltas and maybe a spread because I do
Oh, I
want to
see.
hold the
Okay.
stock for long term. If my intent is only premium harvesting, then I generally sell around 20 deltas or lower.
Oh, 20 delta. Okay.
Yeah.
I see. All right. Good stuff. Thank you.
Cool. Alrighty. We are, I think,
What's the
done.
difference between the 20 delta and 30 delta? Why would you?
So 30 delta has 30% probability of getting in the money. 20 delta has 20. I want to give myself a little more room for error, a little more room for stock to run upside because I love the stock.
So in practice, over last 2 years, how close to 30% or did it come to? I'm curious because I know this Black-Scholes-Merton model where basically the implied volatility is based on so many assumptions in the stock price returns. Like there are 5 assumptions, and I'm just curious. You guys sell based on this religious notion, hey, 30 delta. How close did it come to 30% probability?
Okay, so I don't track it on individual stock basis, but I can tell on overall portfolio level.
Yeah, overall 2-year period.
So if you sell around, let's say 25, 30 delta, then you have a 70% probability of profit, right? 68.2, correct? One standard deviation. And if I look at my trades, I'm looking at 2025. I didn't share it on Twitter, but I think I have it on a document. I'm looking at that. And on individual trades, 79% of the trades were profitable for me. So I am hitting close to 70s, and if I go back to my previous years, it's similar to that. It's between 70 to 80% of those option trades are profitable. So if I'm doing majority of the trade, and again, I don't think we can just generalize it, but if you do majority of the trades in a highly liquid underlying at a 70 delta, you wait, and if you do enough occurrences, you will hit closer to that. And I'm okay as long as I'm hitting around 70% success rate in terms of my option trade. 70% of them are profitable. 30% I lost money in those, just to make sure when I lose, I don't lose big enough that it should negate the whole 70%. So this year it's been 79% were winner out of whatever trades I closed. I closed almost 1,592 trades. 1,261 were profitable and 331 were losing trades for me. That turns out to be 79%.
Can I ask one question? So when you're looking at trades, obviously it's whenever it closes, but then you said you hold your stock for long term. So when you're talking about the profitability, you're looking at the initial profitability when you sell in the delta, right? You're not looking at like the longer term, because some of the stocks obviously go up and down. Am I correct to assume this?
So these profits are purely option raised profits. So these profit numbers are option rate profits. Oh, okay, I think I should clarify this. This performance is my end. It includes everything, which is including stock appreciation. But these numbers are only profits from option trades. Does that make sense?
Maybe I'm still learning options. I just want to understand like the concepts, but okay, I'll take that. Thank you.
All right, let me answer.
What do you? Oh,
sorry.
What do you think of Berkshire Hathaway stock right now? It just seemed like it's going nowhere. Do you think because he left that it's not going?
I think that's the reason. That's the reason why market is like a little bit of jittery in terms of how Greg is gonna do it. But I am still hopeful because the type of companies that they own, we will still need those companies, right? Insurance companies are it is still a big float generator for him, and railways, BNSF, energy, those are the ones that are non-AI. And if you generally look at compare the Berkshire Hathaway and SPY, you would see on the days when the SPY were red, Berkshire Hathaway posted better results. So for me personally, I am selling puts or put spreads on Berkshire Hathaway. I'll be okay to buy it just as a non-AI exposure.
Can you show me the holdings that you have now?
I already showed top 15.
Oh yeah, sorry, I missed it.
Where did we go? Not 25 year and yeah. No, today's is this. Okay. Was it up? Yeah, these are the top 15. Let me see other questions. Thoughts on Bitcoin this year? Suresh, on Bitcoin, I have a long-term thesis on it, which is when I started it, it was 20-year thesis. Now it's like 15-year thesis or 13-year thesis on this. I don't know what could happen on this year. I don't care about what's going to happen on this year. But from a policy perspective, all things are moving in the right direction.
So you currently have covered call positions open on all of these that I look at right now?
Not on Mercado Libre because it's not a good instrument to do covered call. Google, I think I have a strangle right now open. Meta, I think I closed the trade. I haven't opened February yet. Apple is only retirement. I've done nothing done. Microsoft, I have Iron Condor open. Shopify, I think I have covered call open on it. Nvidia, I have a strangle. Amazon, I have not opened it yet. I closed the Jan expiration. And right now, I mean, my deltas are where I want it to be. So I still haven't opened anything. Berkshire, nothing. ASML, I have a call spread.
So you
TSM.
strangle, what delta do you go? What's the purpose of the strangle? Is to make money or is to get shares assigned?
See, sometimes strangle means, hey, if I'm still, if my position hasn't reached, if I haven't, my portfolio doesn't have its a full position for that ticker yet, and I'm willing to own more, then I will sell a put, and then I'll go on. Let's say then I'll sell, let's say, a
You still have the
$20,
money then, right?
$30.
If you want to own the shares, no?
Yeah, 20 delta or 30 delta put, and then
Oh,
also sell a 16 delta call, because guys,
to cover it, yeah.
goes up, if it goes up 15%
Yeah.
in a month, I'll be okay to sell a little bit of it.
So I'm saying, I mean, if you want to own the shares, you're not gonna chase it at the money. You still selling, 20 delta is kind of out of money, right? 30
Yeah,
delta,
20
yeah.
delta or 20 delta or 30 delta, and then the stock
Hmm.
falls down. Like today I mentioned, right? I had a put spread on Uber. My short put was at 90 and long put was on 80. Right. And the Uber stock like fell down to 80 and something like that. And then I thought, okay, let me take a loss on option, and I bought the Uber stock. But then I also had I think when I initially did a Uber trade, I had 105 covered call and the 90-80 put spread.
I think Uber Friday, I think was 82 or something like that, right? 82,
Yeah,
83,
but I
right?
had already closed it, I think, on
Oh, okay.
before the new year. So I already closed my put spread and then bought shares of
Yeah,
Uber.
because I have Uber shares,
Yeah,
but
yeah.
I'm mostly doing cover calls right now.
Yeah, so
Yeah.
I'm right now I'm waiting. I think I rolled at 105 covered call to 95. Probably I think I closed it. I'm just waiting for a right now the IV in most of the stock, if you look at IV rank, it's pathetic. I'm waiting for VIX to spike up a little bit to start
It's
selling
gonna
more
happen.
premium.
Yeah, it's
Yeah,
gonna
wait,
happen.
it is gonna happen, and I can wait. I'll wait. So February I haven't sold much premium just yet because the VIX has been pathetic. I mean, VIX was at a lowest of 52 weeks, I think previous last week. It hasn't. I'm just waiting for vol to return.
So in terms of hedging, you mostly hedging from options. You wouldn't buy the opposite. So say for example, TQQQ is for long QQQ or SQQQ for bear. You wouldn't necessarily just say, hey, I see the market going down a little bit. Let me go buy some SQQQ, right? You wouldn't do that, right?
No,
From
that's
a
more.
hedging perspective, right?
Yeah, that's more capital intensive.
Okay.
So on
That
the indexes PI and QQQ, you still sell covered calls or something else?
I sell a lot more calls than I have a unit. So it's like, because
Oh,
that those are the instruments I use for hedging perspective.
oh, you can do that, or you
I
probably
can do naked calls. I mean,
proof.
my portfolio I can do naked calls.
Yeah, he's got portfolio margin. I mean, to give him a lot more margin.
But
Yeah,
I looked at that. You don't get much premium on selling covered calls on SPY, etc., right?
it depends on the VIX.
Oh, how far you go out? Okay, yeah.
And how far you go out. And again, my main intent is, hey, let's reduce some delta and get the cash in. And I mean, this year I bought a lot of stocks, and but if you look at an overall cash inflow into my these trading account, it's actually been cash outflow to pay the bills. But because of the premium I've sold, I was able to buy decent amount of long stock holdings from the option premium.
When you sell naked calls on SPY, what delta do you usually go?
It depends on how much reduction in delta I need. Sometimes I've done a 60 delta naked call on SPY because with one trade I can reduce my portfolio beta weighted delta by 60. So that's all depend on what's my current beta weighted delta is on a portfolio.
So I suppose you have different accounts, right? Because I see your top 15 right here, you hold SPY, right? I mean, if you sell, there couldn't be a naked call, right? There'll be a covered call, right? I suppose you're selling this from a different account, right?
So SPY units of SPY I hold only in my retirement account. So all my SPY trades are all naked.
Oh, okay.
I don't have in my trading
From
accounts.
your margin account, right? You're selling from your margin account.
Yeah.
Okay. All right.
You think the oil would go up because of Venezuela war going on?
I have no idea.
Never think that way because most information is already impounded into the price of anything. If you see a news event, it's already there. So what you have to really guess is how long will that persist?
The most difficult thing is to figure out what's priced in, what's not
That's right.
priced in. So I stopped
Exactly.
playing that game.
That's called speculation. So it's better to create a system which has repeatable signal that you have observed and tuned. Anyway, that's
So if it goes up, I have an XL triangle for February. Hopefully that will come into profitable zone. But there's a lot of time remaining for February, so I'll see what I'll do. But I have no idea what's gonna happen.
Vivek, what's SCHD?
SCHD is a Schwab's high dividend ETF.
Oh, okay. Can I ask you on a single stock?
Just hold on. Let me just go through some of the comments. There was a comment on leaps. So leaps, I don't have leaps. I mean, you can use leaps for a stock substitution. I'm not against it, but right now you will be paying more in again. I'm okay to do a deep in the money leaps. 80 delta, 90 delta plus, because if you're doing at the money leaps, you're basically paying too much in extrinsic value because right now the interest rates are higher and hence the call premiums will be higher. So but I'm okay to do 90 delta anything 85 delta or more leaves. Do I have leaves? Not, because I did some leaps earlier, but then I realized once the leap expired, then it's like out of my mind and out of sight and out of mind. Then I forgot about the stock, and then the stock ran up. So I realized that I really want to actually hold the stock so that I know it is there and I track it. I just don't get that feeling if I have only option trade. That's the reason why I still own a lot of these individual companies. But that's just me.
Yeah.
Leaps
I
is
just
more efficient use of capital.
Yeah, I was thinking basically that, usually if you've got a couple of years out leaps on it, I'm not as familiar with delta and beta and so on. So just you're looking at a longer view with not necessarily as much capital as you would if you actually want to buy the stock or the ETF or whatever it might be, right? So relatively lower costs, but to some extent it's a bit of a fixed. I guess I don't know if gamble is quite the right word, right, for it. So that's why I was curious if others look at that or not.
No, I mean you can you can look at it. There's nothing wrong. But then once you buy at that leap, the stock has to move move up for it to be profitable, and then you're fighting against the time. That is why I want to go deep in the money, wherein you have a lesser extrinsic value, which basically keeps reducing every day. But it's a more efficient use of capital. I haven't really felt the need right now because I'm anyway conservative in using my capital, so I'm okay with not doing leaps. But more importantly, I have seen in the past wherein I missed out some of the stocks because I had just a deep in the money leap, and once it expired, I forgot about the stock. Breakout rooms. Oh, I should open breakout rooms, guys. Sorry. I forgot about that. Let me open all the rooms. Those who want to go into breakout rooms, please feel free. I will address some of the other questions. Thoughts on Netflix? I mean, I'm still have the same thought that right now Netflix was for me. I've not owned Netflix for many years, But given the volatility that we had and the correction that we had in Netflix, I thought it is available at an attractive pricing. So I do have a synthetic stock position on it, and I'm a little scared that after February, January, I should not forget about it. Probably I'm gonna sell a put against it. But if anyone of all the streaming platforms, there's too much competition. Making money is difficult. If anyone can make money or competing with everyone else, I think Netflix can still make it. Just that now it had come down at a price at which I thought it was attractive for me. I'm still bullish and be okay to own Netflix, especially where I don't have any position in Netflix. Aditya is asking, do you ever consider 200-day moving average when selling options on individual stocks? No, first I look at it where the VIX, where the IV is. If a IV is high, then I will look at it in terms of the moving day average. Let's say if it is like way higher, like I don't know if I look at moving day, I look at Bollinger Band. There's a combination of some tickers. Then I'll decide whether I should sell a call or whether I should sell a put, or if it is a middle, whether I should sell a triangle or iron condor. But first I want to focus on if there is enough, the wall is higher or not. Then I will look at in terms of where it is, whether in a Bollinger Band or like, I think I have a chart which basically have 20, 50, 100 day or 200 day moving average. So, but that's not a primary criteria. Ross saying Congress already bought oil stock. Can you share X again and the strategies recap? Where was X? Cool. Anything else? By the way, I see a couple of folks in options and futures room and day trade and swing trading rooms.
The portfolio that you showed earlier around like your top 15, the percentages are not that high of a change. So can I assume that some of that is like if you do dividend reinvestment, that could be the percentage of change, or were you actively buying more stock in that? I can't tell from the percentages because some of them were quite close. Was it dividend reinvestment or were you actually actively buying more shares?
So on my retirement account, I have a dividend reinvestment turned on. On the taxable brokerage account, I have it turned off. And the reason why I have it turned off, earlier I had turned it on because
where you want to go?
Then I have to come and tell you that this week, hey, I got like 0.01 shares of Microsoft because it pays dividend or whatever. And because I do tell you that I had a long position, and then I said, hey, having a dividend reinvestment turned on is too big of a work because I'll get some 0.01 shares or whatever, and then I have to come and talk about it here. That this week I bought these shares. So on my trading account, it is just turned off.
Yeah, and I think the chart's confusing because like this is the first time I think I realized that it's like what you're talking about is what's in your I guess 401ks and right, and then actual investment. And I don't know if you would be willing to break it down, but it's confusing because it's all kind of combined, right? And so that's where I struggle with a little bit understanding it because I didn't understand that I guess originally when you've been sharing it like month to month, but like seeing it all in that portfolio view, it's hard to understand in terms of
it's again it may not be any buying. It could just be because the stocks went up and down, or there could have been buying also. I mean, I don't track on how many units of SPY came in because of a dividend or that. Too much of a worker because I don't want to do much on the retirement side. I track every purchase that I make on my regular brokerage account, and that's what I come and tell you guys here. On dividend account, if I got some shares because dividend reinvestment is turned on, I'll only get to know at the end of a month when I look at my dividend so we'll call my retirement account, and I generate this pie chart. That's when I come to know, okay, maybe I got few more, or but it at the end of the time it all shows up in that percentage.
Yeah, because I mean, I would assume, like, for example, the SPY, like, it's not that high. Well, not that one, sorry. There was another one I was looking at. Yeah, okay. I just tried to interpret it to see, because when I looked at the charts before, I honestly thought, oh, okay, these are all like individual stocks you're investing in the SPY. And the other thing we don't know too is when you bought it, right? So I'm sure you bought it at a very low percentage, and these stocks are increasing. So I'm just trying to understand, like, when I'm interpreting this, what to take away from it.
So this is a snapshot as of that day. Yeah, so I think that will be easier way to understand. It's snapshot as of that day. It doesn't tell you anything about the history of how I arrived at here.
Yeah. Okay.
So just the curiosity that your cash position went up almost 100%. Did you sell it? So cash was 4.23 and 2.3%. Yeah.
4.23%.
So did you sell it, or did you sell any, like, to do the tax harvesting or something, or?
What did I sell?
Oh,
no, I think when I sold, I already told. I'll tell you why this cash went up. One reason is that I had some of my this thing. What do you call? I had a T-bill that matured in December. So when T-bill matured in December, so I got that cash coming in. So that is sitting. I think that's the bigger impact on cash, the maturation of my T-bill.
Just for purposes, T-bill is treasury bill, correct?
Treasury bill, yeah. There was, I think, some 52-week T-bill I had, which was maturing in December, which did get matured, and that's the reason why the cash component went higher. The other one would be if I have because sold some premium on it. I did a box spread in December. That's also basically added back more cash in my brokerage account. These are the two reasons. Any stock sales, etc., I've already shared. I mean, I'll share on a weekly basis because this is what I sold. So I can go back and look in December, what did we sell?
Do you have the link to the recording?
I put it on Meetup when the recording is uploaded. I do put it on my website, and I'll put a message on Meetup saying the recording is available at this place.
Thank you.
Cool. What do want to know also know is what else do you track?
So Vivek, quick question on this topic. Just one last question. So you mentioned you don't do any, option trading on the retirement account. And looking at this, it looks like it's a sizable part of your overall portfolio, right? So why do you decide, let's say, not to generate for example, a very conservative covered call on, let's say, SPY, say 0.05 delta, to maybe let's say 2% on, on the holdings? What's the reason?
I could. I mean, it's not that I actively trade on that one. You're right. I could maybe once in a while I've done on some of my individual stock. When I see that the stock has run up too much, maybe I think this year I did only one on one of my individual stock. But on a SPY, if I were to do it, I'll just do it on my brokerage account itself. I mean, I could do it. You're right that there is no reason, but I can do it on my brokerage account.
But that makes it tax efficient also, right?
Yeah, if it doesn't get called out, yes, it does make it tax efficient. But then it doesn't generate cash for me. I need cash to pay bills. You are forgetting that I don't have a W-2 income.
Oh,
Do you take, like I know in the tax code, I've never done it, but I considered it in a year when I had huge losses that, hey, I could be qualifying as a trader. Do you do that?
No, I thought of this, but then you have to do mark to market and all that stuff. And then I think the brokerage also start charging you for data and all that stuff. So what I realized is maybe I should keep an eye on my realized gains and try to do the tax loss harvesting. So I have not yet, uh, you know, um, classified myself as a full-time trader.
I can
I don't know.
offset.
I'm actually open for that. If anyone has done it and can tell us these are the advantages.
I mean, if I had done other earned income coming in, it'll be a great way to completely wipe off that income.
No, if you have other earned income coming in, then you actually have a IRS flag antennas goes up. So as long as I had a W-2 income coming in, I never even thought about it, even though I was actively managing my portfolio. Now, because my CP also told is if you claim a tax trader status, sorry, if you claim a trader status and you have a W-2 income, that's like IRS red flag will go up. Now, last like 2.5 years, I don't have W-2, but then I didn't. I'm still. I mean, I'm not spoken to anyone or no one has told me saying what is the great benefit I will achieve, except the case that you cannot you that wash. I think the wash rule doesn't apply, but then you have to do mark to market. What is that other stuff? If anyone is actually has that status can share, that'll be great.
No, I had thought that earned income could be offset by trading losses. So in a year when I had 30K trading losses, I thought, hey, I could reduce
Up
my.
to 3,000 only.
No, but he stopped up to 3,000
Okay,
is
but if
for
you're
the
trading,
better ones. I think
if
he
you're a
stopped.
trader, then you would have a Schedule C, which is a business, and then you will. I thought, but maybe I'm wrong. Your CPA knows better.
So only thing is, hey, there is one thing which say, hey, you incorporate it as a business, and then if I go to conferences, etc., I can claim that as a business expense. That's a different that in terms of incorporating under a legal business entity.
But then you keep all your taxable losses inside that entity. They don't come into your earned income.
Yeah. So then there is a little more headache. I mean, I've not spent any money in going conferences except Berkshire Hathaway, so I don't have too many to claims anyway.
Yeah, but you can claim your house expenses, your office expenses, all those
Yeah.
things.
So we try to do that in my wife's, but that comes as a 1099 income, as a rental income. If I were
Yeah.
to really do it, I like my wife has a business and we can claim it under her.
Yeah, but that's always the thing is if it's your own house,
Yeah.
it's just like taking one pocket and out the other,
Yeah,
right?
exactly.
You
So
deduct it on your business and then you have to show it as income on your personal.
yeah, so that's
So
what happened. So this year my wife was like, "Hey, we have not collected it." I said, I'm not sure if it really makes a difference because you have to show as a 1099 rent. So you can get an expense on the business, but I don't know.
I'm
No, but
curious, just
it's a
curious.
personal. Again, again, if you are running the business from your home, that portion of the house becomes a business entity. So, and but again, you have to pay the capital gain and when you sell it at the time.
Oh yeah. So and I haven't. I mean, if someone actually has a trader IRS classification that day trader or trader status, I would love to talk and understand the benefits and do it for myself. I
No,
haven't.
why don't you become a full time in a like a fund manager?
Okay, completely
And you
different
can do
topic.
prop trading. So Vivek, you know about this thing called prop trading.
Yeah, prop trading firms.
So why don't you get some capital from those folks and
Someone has reached out to be, and I know that these are like a white collar sweatshops. Right? I don't want anyone to be hanging over my head and say, why I'm not doing this? And I'm forced to make this percentage. And when you're forced to make some percentage, you're gonna take some stupid decisions.
I'm curious, I was looking at your profile when you were sharing from your screen. It said, okay, you're a DIY investor. Is this pretty much now you're full time where you're able to pay all your expenses from trading, or is it still part of a?
No. So this is my full time. I've been full time on it since 2023 June-ish, I think.
Okay.
Yeah.
And you're
That
able
is why.
to,
So this year I actually had to withdraw cash from my active trading account, and someone had asked, right, why don't I sell an option over in my retirement? No, I want to generate option in my regular trading account so that I can withdraw it to pay bills.
yeah, that would be part of, that whole cash discussion, right? Is you're not just trying to regenerate and put it back in, you're also paying yourself to be able to cover your expenses and things like that, right? So,
And in 2025, I think I will have to withdraw more than in 2024 because I don't have that many T-bills maturing. So either I had to generate it through by selling more premium, or maybe I'll have to sell some of the stocks, whatever. I have to figure out how to still generate cash.
thank you.
Mhm. Cool. Right. Anything else? Otherwise, we can jump on to breakout rooms. There are 2 rooms which are active.
Let's see which one is active.
Any other conference happening here? I'm still planning to go to Berkshire Hathaway in 2026, because what I liked was the other events that happen, like Markel conference is there, and then there are, I think, other investing forums. They do their own events. So it was, I loved that a lot because it was a good opportunity to go and talk to some other investors, fund managers, exchange ideas and stuff like that. So if some of you are planning, maybe we can meet there in person. Too late for uh, oh, okay. So Shri's response was to Aditya. I'm like, why is it too late? Oh, that's for tax loss harvesting. Yeah, tax loss harvesting is too late, and planning for Berkshire is too early right now. Alrighty, I will let me see which breakout room to go to. Any other questions? Otherwise, I'll join breakout room from my phone. I'll disconnect here.
Yeah, I have a question.
Sure.
Single stock. I saw a presentation by a credible YouTuber.
Sorry.
Lucid.
Sorry. I mean, when I YouTuber and credible.
No,
something
no. He's not selling anything for
Okay.
information. He's not trying to sell anything, but he presented the case of Lucid, which is owned 59% by the Saudi Arabians.
I know.
Any thoughts on Lucid?
See, Lucid is again,
it's a loser stock.
I don't care about the stock because it is, Lucid currently is like a kid that has just been born. It's still in NICU. So you can't say, oh, the kid is not behaving properly. It's not, the manners are not of it. You never know. So Lucid is just born. It is in NICU. It will continue to need outside help to breathe. It will continue to raise capital because it doesn't know how to breathe on itself. They are not making any money by selling cars. They are just losing money. So they will always need outside capital. And that is why the shares will jump up anytime when they have a capital injection coming in. Now, the bigger question is, if can they continuously get that capital injection till the time it grows up, it grows its lungs, it knows how to breathe on its own. So if you want to invest in Lucid right now, it's going to be a gamble thinking that this kid will survive and can become LeBron James of future, or pick up whatever the sports person you want to. So if I want to invest in Lucid, I will invest very small capital until I see them turning around and generate and able to scale their operations at least at a break even. Right now they're losing money in every car.
Because Saudi Arabia is trying to create industry. They want manufacturing over there, so you don't want them to Saudi. Because you remember a Prince in the 90s by Citicorp, but Citicorp in the 90s went nowhere, right?
I was not invested in Citicorp and wasn't tracking, so I don't have idea.
No,
But
no. So I mean, I figure if a country invests 60%, I mean that's quite a bit of money in it. So
so Saudis have their fingers in lot of stuff because they want to diversify their collections, away from oil. They have seen the writing on the wall that in future, let's say, when I say future means 20, 30 years, 40 years, consumption of oil will reduce and rest of the countries will move towards other sources of fuel, and they want to diversify and invest in other industries. Saudi has got a lot of money coming from on the crypto side. I mean, Saudi has become a big hub for crypto innovation. They have bought stakes in a lot of are these Max 7 companies. They have given money to a lot of VCs to invest in startups, so they are diversifying it, and in some cases they are taking direct stake, like they have taken maybe in Lucid by giving them money. So I'm not just going to invest in Lucid because Saudi has invested in it, and that doesn't mean anything. That doesn't mean that they have a huge confidence that Lucid is gonna become next Tesla. They're just diversifying their bet, their own portfolio among hundreds of companies, and Lucid happens to be one which is in need for funding. So that's why. Suresh is asking, what news or other source of information do you subscribe to in order to track your stocks and the markets? On a daily basis, if I'm on Think or Swim, then I mean, it, where does that go? I mean, it will show up what are the news or the story around it. So this is generally what I look at it. I also look at X if there's some news coming in that helps me. But majority of my study is through going through the earnings report, etc., which is on quarterly basis. But between the quarters, etc., if there is a press releases, if the CEO is talking in, let's say, Goldman Sachs Technology Forum or JP Morgan's Tech Conference, I'll go and listen what the CEO has to say on things like that. But yeah, Barron's, I used to read, but I just don't get time. I haven't, but Barron's is good. Bloomberg Weekly is good. But yeah, these are my sources.
Thanks.
I found this Think or Swim's feature of giving you the news. This is on a daily basis. I just love this because I'll have it. This is a paper account, so I have any note.
So do you curious for your trading and stuff? Do you use Schwab, or what's the site do you use?
I have account in. I had account in TD Ameritrade, which got bought over by Schwab. So that's one, and then I have other account I have with Tastyworks. So these are the only two accounts I have.
So that was Tastyworks. Okay.
Tastyworks.
What do you see as the differences? I'm not familiar with that one. I'm just curious what's the difference.
So I owe all my options education to the folks who founded Tastyworks.
Okay.
So these are the guys who founded Thinkorswim platform, who created Thinkorswim platform. These are the floor trader guys, ex-CBOE guys who created Thinkorswim trading platform, probably the best for options trading. And then they sold it to TD Ameritrade. That's how the Thinkorswim tool went to TD Ameritrade. And they created, started working on Tastyworks as a platform. So, and they also had a lot of, if you go to their website, tastylive.com, they have a free content related to options education. I started watching them in 2016. So that's when I got into options in 2016, and as a part of my, call it as a fee, I opened an account, became their customer. So that's why I'm a taster. And they have a lot of great features, let's say, which they did not implement in Thinkorswim. Like, for example, when you're doing your option trade, you'll know what your 50% probability of profit is, P50, which Thinkorswim doesn't have it. But for my main reason was just to pay my tuition fee, because I learned everything from them.
Okay, thank you. Appreciate the information. Hey, today was really great. Really appreciate all the information and discussion. Really enjoyed it. Thank you.
Cool. Glad you enjoyed it. I hope to see you again next week.
Yeah.
We generally, talk for 2.5 hours, then it's a freewheeling discussion. So, all right, if there are no other questions, I'll drop off from here. I'll join on my phone. I'll have to head out for lunch and probably pop into one of the breakout rooms.
Enjoy your lunch. Thank you.
Thank you.
I have one question.
Sure.
So I've just been trying to do the numbers on my account, and I mean, I didn't beat the market.
Doesn't matter. It is immaterial. There have been years where I'm not. 2021, I actually lost money.
Right.
Market was up and I lost money, and because I was working at that time, I didn't realize what a crap company I was holding. And everyone pays tuition. Now
Right.
today I was going back and looking at my performance. I'm like, what the heck I was doing in 2021? Market was up 18% and I'm
Yeah.
like down double digits. I'm like, what the heck?
Right. So yeah, I was just trying to do like an honest review of, I mean, I underperformed the market. Now I want to, unfortunately, the time period's only about 6 to 8 months, I would say. So it's probably possibly too soon. I don't know. But I was just trying to gauge it objectively, if it was incompetence, if it was bad luck, if it was just or if just trying to
So you should look at in terms of what you hold in your portfolio, right? So you should look at what companies are holding in your portfolio and question yourself, why did I buy this? Did I buy this because someone talked about it, it's a hot company, or do I really understand it? What kind of businesses you own? And that was my biggest mistake in 2021 was I bought a lot of a shit which I still hold, which is down 70-80%. uh, I had no idea in terms of, I did not do my own research, and I followed some good YouTubers. I mean, you would have heard of, if you are on a YouTube or on Twitter or on Brian Feroldi, he's a very good educator. But they were okay, and David Gardner's portfolio was down 60%, but he's okay with that volatility.
Right.
I didn't realize that I bought some of those high beta companies without realizing what kind of investor was I. And and that's happened in 2021. I did not clean up my portfolio because I had gone back to job and didn't pay much attention. Once you have a W2 income, you become little, yeah, it's okay. I have my bills being paid, and you become little more,
Exactly. Yeah.
you know.
Yeah. So in my case, I mean, I think for most of it, I was just sat on a whole load of ICSH looking for opportunities, and then some tickers I lost money on were basically PayPal, Bitcoin, and C Limited. So now I'm just and it's a long-term play. So I'm also sitting and sort of holding on to it. But I was just thinking if there are sort of clear indicators that will help me ascertain that, oh, I underperformed the market.
So how big is your ICSH position? Let me ask you, because that's, if you're holding too much of a cash, then it becomes very, very difficult for you to outperform market, because
it was more than
cash is
50%.
more than?
More than 50%.
Jeez. Even what Warren Buffett has underperformed the market because he holds so much cash. Unless you have taken some extreme amount of a risk, there is almost impossible to outperform the market by holding 50% cash.
Right. Yeah. Yeah.
Uh,
Yeah.
Maybe the best thing could have done is like, hey, maybe I'll just hold SPY.
Yeah. And that I do. This is I think this last year was my first time
Yeah,
dipping into options and doing all these things. So I was you know, learning, being careful and to just dip in the toe sort of a thing.
yeah, and that's what I'm saying. I'm like, it's okay not to beat the market. I don't. I think someone has to do have a target. I don't start my year thinking how to beat the market. It's just sometimes I get lucky because the stocks that I hold, like Chinese stocks, did well. Chinese stock did not do good in 2023, but when Chinese stock did well this year, and I got lucky in that, and so that's the reason. But yeah, if you're holding 50% cash, it is very very difficult to beat the market. It's a
Right.
drag.
Right. And there isn't like a simple indicator somewhere in Think or Swim that'll show me how much my sort of risk adjusted return in my portfolio versus the risk adjusted return in SPY or something like that.
Not that I know of. And somehow the longer time I spent on investing, I think the traditional definition of risk adjusted returns, I don't subscribe to it anymore, and that is why I stopped tracking Sharpe ratio.
Right.
I used to track Sharpe ratio. I stopped doing it because if because that talks about it considers volatility as a risk, which I have changed my thesis that I don't consider volatility as risk anymore. And that's why I stopped tracking Sharpe ratio. So if you look for any other, I think pre-built signals or pre-built studies in Think or Swim, but if they consider volatility as a measure of risk, the dispersion as a measure of risk, then you really have to understand, is this when you are investing, is this how you're investing? Are you staying away from more volatile stocks because you want to have less risk? I'm not investing that way. I'm okay to hold a stock which is good high growth stocks, but that's gonna be stay volatile like Mercado Libre and all that stuff, which could go down 50%. I will manage my risk through the position sizing. So I don't consider, that's why I stopped looking at Sharpe ratio, etc. I don't consider volatility as a measure of risk. I consider like the stock going to zero as a volatility of risk.
Right.
Because you could still have a stock that is less volatile, but it continues to go down, and eventually goes to zero. I
Yeah.
think that is a much bigger risk than a stock that is too much volatile but is going up in the north. So
Yeah.
once I changed the way I invest, I thought, okay, I don't want to look at a traditional measure of risk.
Right. Right. No, thank you. Yeah, I'm just doing these experiments, trying to sort of come up with my system and refining it and tuning it. So let's see.
What would you suggest if someone want to transition to full time? I haven't been successful,
You
so I
have
was
to
wondering.
you have to love the game of investing. If and again, this is my thought process. If I were to do only for money, probably it will not a success. You have to love the process of it. Money will come along with it once you become more educated and proficient in it. But you have to love the process of investing, reading about companies, talking about it, going through earnings, going through podcasts or whatever YouTube sources of information and education. Right? Unless you enjoy this process, it's going to be a very very difficult. It's like working in a job that I hate just because it's paying me money. you're not gonna succeed in that job. So, and
Yeah,
if you love the process,
I do like it. What steps should I?
then I think you have to determine, you have to obviously make sure you have a capital build up to have a portfolio, and then you have to run it along with your job for a few years to get enough confidence saying, I think I can generate this much amount of return before you kick off your job or don't go back to your job. So I can only talk about me personally. I did it from 2016 all the way to 2023 before I got enough confidence and built up the capital to see, I think now I can manage my bills. And of course, situations are different, right? One kid was already out of college. So I'm like, okay, one less mouth to feed. She's on her own job, right? And then for other kid, I think I've saved enough for her college. So you have to determine and look at those expenses, manage your personal finance side and see how much do you need and can you generate enough on that capital or not. And
How
also
much?
I was lucky because 2020 was bearish market and I knew that the companies, some of those companies that have been beaten up and the market will turn around, and I actually wanted to make sure I can spend time in understanding and buying good companies with them. So I got lucky. So you'll have to go through that process.
So how big of a portfolio do you need to make, let's say, 100,000 a year?
So if you
Oh,
look at a general, and again, it'll be different for different one, but if you look at a general financial advisors will tell you 25 times of your annual income, of your annual need. So if you're looking for 100,000, this is called a 4% withdrawal rate, which I was listening to the guy who had actually kind of invented this or popularized this. He said 4% is not anymore. You could do around 3% as well. So if you're looking at, let's say we stick with the 4%, which is what general financial advisor community sticks with. If you want 100,000, then you need 2.5 million.
no, I mean,
That
stock wise, like if I want to generate 100,000 for 1 year, how big of a stock portfolio do I need?
so what I told you, 4% is you can safely withdraw 100,000 at a 2.5 million portfolio and still be able to, because the market on an average continues to go higher, so you'll still be able to, you know, survive and have your portfolio available with you. Now, we're not looking at 4% because I didn't have that 4% stuff. But now I know, like I was sharing earlier, that I can generate 5 to 10% of a cream on top through my options income. And then I look at is of, is that income good enough for me to manage my household for next 1 to 2 years? But then I also looked at, okay, I had these T-bills which are gonna mature, some cash will be coming in from there. And then I decided I think I can try this right now. So you have to determine how you have to track your own performance for a few years and see, can you generate 5%, 10% on on your own, because you just can't depend on market. What if market goes bearish tomorrow? But
that question that just came up, when you say that you need 2.5 million, that's based on dividends, right? So when you're saying you're going to get 100,000 done, it's based on paying for dividends, or how do you?
yeah, it's like I mean, I just threw the number because that's what the financial advisor community use. I'm not an advisor, but if you read mostly, they'll say 4% is a safe withdrawal rate. You can, let's say you can invest, you have a 2.5 million, invest in S&P, and either you get through dividend or maybe you sell some of it and withdraw 100K of it every year, you shall still be okay. Now, what they don't talk about is a sequence of returns, because 10% on an average looks good, but what if you stop working, you enter into retirement, and first 4 years are bearish? That's a horrible situation, because then you'll, by the time the market turns around, your 2.5 million is already drawn down a lot, and then you can end up into a problem. So I don't think there's one answer, but the 4% rule, which most of these retirement planners suggest, is you should have at least 20, 25 times of your annual spent in your
Yeah.
portfolio.
I think usually you hear about that, what you just talked about, when you have a down market, or every time there's a down market, you'll hear about all the retirees who just retired who have that, right? One possibility to help offset that is essentially if you've got, depending on your risk appetite, somewhere between 3 to 5 years of your income needs, your expense needs in cash or T-bills or some, equivalent like that, that allows you to be able to say, okay, if I retire today and the market goes down 50% tomorrow, over a 3 to 5 year period, it's going to come back. And so I don't have to sell that 4% at the bottom. You kind of rely on that portion. So that's one way of helping to offset that I've, kind of heard about.
Yep.
To put in the treasury bills, because the interest rate you lock it in, but the challenge is like right now the interest rates for these accounts are like 5% or whatever. So like you would basically be losing out, but then you have the security, I guess, of getting to the locked in rate. Yeah. Okay.
Well, it's not even the locked in rate, right? You're basically trying to avoid selling your stock right when it's gone down a huge amount, right? So if you think about the .com, the '08s, the whatever, every time we've had a big one, there'll always be a lot of news articles about the people who just retired, exactly what Vivek was saying, right? Because they'll go to withdraw that 4%. It's down for 3-4 years before it recovers, but your impact of that 4% is much bigger. I think that's what Vivek was also saying. And so the one way of avoiding that is if you had cash or cash equivalents that cover you for whatever your living expenses are going to be, let's say for 3 years, then you can try to outweigh that, right? You don't, you continue through that. You're 3 years in, hopefully the market's, done, come back, right? And again, like I said, that's your risk appetite. Some people will do 5 years on it. Once you've done that, when it comes back up, then you can say, okay, I'm going to replenish my, midterm bucket and rebuild and sell more to get that 3 to 5 years to build back up, right? Something like that. So it's more about managing that portion of it.
So it looks like if there is an interest in this topic, I actually read an article which I found really interesting, and maybe I can bring that up something for the next week. Oops, not this one. Is 4-year cash reserve strategy for retirement. It was written by a couple who had, retired, but then they shared in terms of their experience on how they managed the different phases, how they prepared for it, make sure that they have 4-year cash available, and what to do if market goes down the moment you retired and all that stuff. So maybe I'll talk about it next week. Looks like folks are interested.
Yeah. It would be great if you could share, because we're going to be out the next couple of weekends. We're going on a vacation, so I won't be able to attend next weekend. But I would love to, if you can.
You can always watch the recording, but let me. I don't have the URL for it. I think I read through it, and I think I gave the URL to Gemini to give me a summary. Let me find out if I can find out the original article. But there was a couple who basically shared saying what process they followed to make sure that if market goes down the moment they retire, what should they sell and when to start to buy again to replenish it. So they shared their strategy plan. I liked it, so I just added it to my knowledge base. So since you guys were talking about it, I thought maybe the next week I'll talk about it.
That would be great. Thank you.
Yeah, I'd love to see that. Thank you.
Right. Do you use any software to track your transactions or returns? I don't use softwares, but I do download let's say when I'm looking at an everyday basis data, I just go to shop and download my daily balance information from them. And I know at the end of a month, I have information coming from a account statement, and then I just use it at end of a month to see, how I did month to month basis, and then at an annualized basis.
Okay. Yeah, I used to use Quicken and lots of this you see newer software, but they all seem to be concentrating on the flash and graphics and things rather than the core information. So I was trying to see if others have had any better experience.
Quicken is still alive?
It's alive, but I've used that for, I don't even want to say, pretty much from the beginning, like early 90s when it first came out. And it was been really good. But the problem is, I think they, like everybody else, is now concentrating on the flash and the fancy graphics and things. And the core of making sure the information is correct and doesn't get, corrupted and all these things, nobody seems to wants to do, right? So that's why I was curious what you might use.
So I spent a decade in a company which built products which basically do the financial data aggregation. So companies like Mint, they used our software development kit to build their data aggregation platform. I was managing Bank of America, Fidelity, Citibank. These were all our customers, and they used our products. Let's say if someone has a Bank of America account, they provide an ability to you to aggregate all your external accounts, non-Bank of America accounts, and see it as one place. They call it as my portfolio. Fidelity calls this as a full view. I think CD used to call it as a tools, and they classify under tools or something. So most of these big banks and a lot of fintech companies were our customers. Our product was white label, means you will not see it, but if you click on a Bank of America my portfolio, you're basically on my server. So I was responsible for all these big clients, and it was great. But once I became serious, and I left that company in 2015, I worked from 2005 till 2015 in that company, and I became a serious investor. I'm like, I can't use that shit anymore. It doesn't do this. And I was still in contact with the folks. We still meet. I'm like, dude, what the heck? You can, it basically build all the PFM, right? You can do your network tracking, you can do your transaction categorization, you can set up a goal and all that. I'm like, if you become a serious investor, it's not helping me. Then they told, okay, even Personal Capital, they used us as their, they use our SDK to build their stuff. And then the company got bought over by InvestNet in 2015. And now InvestNet, I think this year they spun it again. It sold it to private equity. But anyway, I realized that even though we had 80% of the financial data aggregation market, that time Plaid wasn't even there. Now Plaid has got a lot of that market. And still, it only does the basic stuff. It wasn't good enough for a serious investors.
Yeah, I mean, the thing, like I said, I used to like about Quicken is you could track everything, right? Your regular credit cards and your bank accounts and your investments. So you could really see how your investments are doing, what you're spending, what's your cash flow, one picture, right? But it just seems like they've kind of lost their way and are trying to not really uh, keep it up properly, right? So that's why it's like, and a lot of the others I see, advertisements for Empower and this and that, they all seem to focus on segments of it, like maybe just the investments, exactly like you said, as an aggregator of information or things like that, but not necessarily that full view. So
yeah,
doesn't sound like anybody wants to get into that market.
So I'm willing to get in. Who wants to get in with me? Maybe we build something for individual investors, because I couldn't find any brokerage firm doing this. And I'm like, hey, we spent 10 years in building our own products. Those are only good for doing basic stuff, goal tracking, budgeting, getting to know your net worth, where you're spending money, but not really from an investor perspective, especially DIY investor. Right. So I'm like, okay, I build my own stuff to track all these things.
I'm here.
Yep.
I couldn't find any brokerage firm doing it for me. I mean, they heck don't even track if I roll a trade, they'll forget about it. They don't even track that this is a roll trade and my premium should be carried on. Anyway, all right, I have to head out. I think my family is already waiting. I'll probably join from phone, but I have to head out for
Yeah.
lunch.
Okay.
So see you all
See you next time. Thank you.
next week. Thank you, everyone.
Thank you. Ready when you are, Vivek, bhai. On the last thing you mentioned, building something. Yeah.
I'm just thinking that maybe once my kid goes out, I maybe spend a year in traveling before I get back to building stuff. Because no, one thing is very clear. First I thought maybe I should start focusing on that, but then I realized I want to be a great as an investor because there's a lot more ROI. And any business you want to build in, you'll need give it 10 years, 15 years, right? And I right now just wanted to focus on spending a lot more on becoming on investor in terms of understanding and companies and all that stuff and that, but it's always on the back of mind because I know that no one else is doing it. And I've gone
Yeah.
through the pain of trying to figure out these numbers by myself.
Yeah.
So there's definitely a need for it.
And I know what you mean, but I think the buildings come in a long way as well because I'm seeing just Claude and stuff are just building interfaces, Replit's
Oh yeah,
building the
building, I think
back
building the
end.
product and building a product probably is not that difficult.
Ah,
You can always
yeah.
get it done in few months. But building the business, which means
Yes.
continuously, so no business is easier.
Yeah.
And I didn't really want to commit myself, until my kids goes out to college on, you know, getting tied up in again working for a startup. I spent enough hours working on not paying attention when my elder kid was younger. So I'm like,
Yeah.
I don't want to do that for my younger. Let her go out of house, and then I'll get back to working dog hours.